Please welcome to the stage Joanne Barefoot of the FTA Advisory Board, joined by Meredith Fuchs of Plaid, Tom Devlin of the CFPB, and Sharon Ann Keene of WISE.
Sorry. Hi, everyone, and welcome and greetings. It's wonderful to be at this first ever summit, and exciting to see the turnout here. And I will say I'm thrilled to be a member of the FTA Advisory Board. And we have a panel that I think you're going to really enjoy, talking about open banking. And open banking in the United States is like hardly even a thing. It's something that we haven't spent years talking about, unlike in other parts of the world, where it's a very well-developed concept, but it's crucial to the future and the well-being of consumer finance. So I'm going to ask you, Meredith, to set the stage for us, talk about why consumer access to data is so important, how it's going to impact the financial landscape, and then give us the first sense of what the policy responses need to be.
Sure. Well, you know, consumer data is just like, and consumer kind of interaction in the world is just like everything else in financial services. It's just like it is in every other part of the world. So everywhere people want things to be fast, easy. They want things that are personalized. They want things that serve their needs. That's what's happened, and we see it in all the apps that we use. The same is true in financial services. Right now, 8 in 10 people in the United States use fintech apps in order to handle their financial needs. That's the kind of thing that shows that there's like a strong consumer demand for being able to use technology to manage this part of their lives. And what's happened in the United States is that, you know, we've, through statute and through kind of businesses and innovation, we've begun to see that there is like this incredible promise to provide these services directly to consumers in ways that are accessible, are fast, expand access. Ooh. So, see, it's very exciting. And I think, you know, I think you also asked a little bit about like, what are the policy issues? You know, the policy issue, the core policy issue is, you know, who controls the data? And we've talked about that a lot this morning at this conference, is that, you know, it's really the consumer who should be able to make decisions about how their data is being used. And that's like the fundamental policy issue that I think requires people to change their mindset from a mindset where like a business holds the data and they can do whatever they want with it, and it's not the choice of the person whose data it actually is. I know we'll talk more about that, so I'm going to pause there because that's, I think, a core issue.
Great. And Sharon, let's go to you then, talking from the standpoint of WISE on why these issues and this data are so important for the benefit of your customers.
Yeah, sure. So at WISE, our mission's about helping people move money around the world. So if you need to make an international payment, we try to make it faster and cheaper, eventually free, that's what we hope, but also more convenient for people. And it's not convenient at the moment if you use your bank to send money around the world. Often it takes a long time, you don't really know what the fees are, and sometimes the money doesn't even arrive. So with that mission, getting it away from banks and giving customers more choice is one thing that we think open banking definitely helps with. So if you share that data or how customers are being charged, it gives them more information with which to choose what service they use. The other part of it is around connecting that data between apps. So I think the stat was 9 out of 10 people using fintech apps. That's incredible. So people are seeing their finances in multiple places and being able to look at that and compare that across those apps by connecting it. Again, open banking is a really good enabler for that. And then the final bit, which in the UK we're a bit more progressed on, is actually enabling payment initiation from these apps through open banking. So the ability to just essentially make a one-click payment, that's probably the dream, and make it a much more simple process to move money around. And if you've got a structure and a set of principles around how data can be moved around like that, and you've got some guidelines around who owns it and permissions, then it's just a much better environment for consumers generally. And we try to do that at Wise. And any kind of structure around open banking that supports that's a good thing for us and for consumers, most importantly.
So, Tom, you're the person of the hour here. I think when this panel was planned, correct me if I'm wrong, I don't think we knew that Director Chopra was going to be announcing a game plan for the 1033 rulemaking. I was in the audience at Money 2020 when he did so, and actually I was moderating the next panel on the topic. So tell us about the CFPB's game plan on this timeline, what we should expect.
Yeah, of course. Thanks for having me. I'm going to start with everyone's favorite part, which is the disclaimer, which is that I'm here representing the Bureau, but what I'm expressing are my own views and not necessarily the views of the Bureau. Although, as I like to say, I hope I'm close. So just to give everyone a sense of where we are in this process, the CFPB is subject to a statute called the Small Business Regulatory Enforcement Fairness Act, or SBREFA, which requires us, before we propose a rule that's going to have a significant impact on small businesses, to convene a panel of small businesses, obtain their feedback. We do that panel in conjunction with the SBA's Office of Advocacy and OIRA. And so the outline that we released a couple weeks ago is going to be the basis of that small business consultation. And to sort of give folks a sense of what's in there, you can think of the entities in the ecosystem sort of in two big groups. The first group is what we call data providers. Section 1033 of the Dodd-Frank Act refers generally to an obligation of covered persons to make data available. Those of you who are familiar with the Dodd-Frank Act know that the category of covered persons is incredibly large. And so we are not in this outline contemplating trying to cover the entire field of covered persons. Where we are starting is with certain consumer transaction accounts, primarily asset accounts under Regulation E, and credit card accounts under Regulation Z. And the proposals under consideration would contemplate a data provider having to make a secure portal available both for consumers to access that data directly themselves and for the consumer to authorize a third party to access the data for them. And that's where you sort of get the other bucket of entities in the ecosystem, the authorized third parties. And so in order to be an authorized third party under the proposals under consideration, the third party would have to make a certain set of certifications once they obtain the consumer's consent to obtain data on their behalf. Those certifications would include things like specifying the use for the data, making certifications that the third party is going to limit the collection, use, and retention of the data to that which is specifically needed to provide the service that the third party is actually providing to the consumer. And so, that's sort of at a very high level. We didn't get quite as long as the Treasury document, but our outline is a little over 70 pages long and goes into this in a lot more detail. But that at a very high level is where we are in the process, and we're looking forward to seeing the feedback from the small entities, seeing the feedback from other stakeholders, and continuing on this rulemaking process.
So first, I want to say how impressed I am by the way you say the words that SBREFA stands for. I know many regulators who can't. I won't take a poll of the room, but that was very impressive. Talk more about the motivation, including particularly, we know that Director Chopra and the CFPB have been putting a big priority on fostering competition and also obviously on consumer protection and privacy. Talk a little more about what you hope will come out of this step that you're taking.
Sure, so maybe we can start with the competition aspect of that. I think there's a couple of ways you can think about it. The first one is both sort of allowing for the development of new products and services and for the improvement of existing products and services. And so if you look at cash flow underwriting is a great example of a use case that is really facilitated by third-party consumer access, third-party data access. And there is research that suggests that cash flow underwriting may actually allow for more accurate underwriting and potentially underwriting that might mitigate potential concerns around fair lending and racial discrimination in the lending system. And so facilitating those kinds of use cases can be really helpful. It also ensures and it helps small companies get in the game, so that small companies who don't already have access to a large pool of consumer data because they aren't a large financial institution with a big pool of consumer data, can also have access to that data and really let consumers choose who they're going to get their products and services from, and they're not limited by where their data already is. And then related to that, I think we are looking at the possibility that this regime might also enhance the ability for consumers to switch providers and switch accounts. Being able to potentially bring part of your transaction history from one provider to another provider might make it a lot easier to switch. For example, if you wanted to switch a bank or switch another provider, it could be potentially done more seamlessly if you have the ability to sort of bring that data in an electronic format that your new provider can bring in sort of without some of those switching costs. And so hopefully by making it easier for providers to switch, for consumers to switch providers, it encourages better competition. It encourages companies competing really on who can provide the best product, and not just relying on the inertia and momentum of already being the provider to the consumer.
And one more question for you, Tom, before we broaden it out again. How are you consulting with other agencies as you work on this?
Sure. So Section 1033 already specifically directs the Bureau to consult with the federal banking regulators and the FTC. And we've been doing that. We've done that for quite some time, and we will continue to do that through the rulemaking process. Obviously, we're also consulting with the SBA Office of Advocacy and OIRA as part of the SBRIFA process. In general, we certainly recognize that there are a lot of equities across this system and a lot of folks who have real interests in this rulemaking process. And so we've done that consultation. I think it's been really productive, and we're really looking forward to the ongoing engagement with our fellow regulators.
So let me ask both you, Meredith and Sharon, what you're hoping will come from this and maybe what you're worried about as well. Meredith, you were the former general counsel of the CFPB, so you've got a double lens probably on this whole process, so start with you.
Well, first of all, I'm so excited that CFPB is now working on this. I mean, I remember when I was at CFPB years ago, and we were kind of working our way through the Dodd-Frank Act to figure out what to do. I always thought this was an area where there was so much promise for consumers. And so, there were some other problems to deal with first, but now we're here, which is exciting. I think there's probably three big things that I really, really appreciated in the outline. First is the focus on, affirming the consumer's right to access, because while that is in the Dodd-Frank Act in Section 1033, the CFPB has made very clear that that is not really in question. That is something that, is essential. And, I talked about earlier, the idea of a consumer-centric concept, that's never been said before. And so that's a very, very positive thing. The second thing is, sort of the concept of oversight. In order for this to work at all, there needs to be trust and security in the system, because the way the history has been is the banking system thought well, as long as it stays in the banking system, we can be trusted. Well, now we are talking about broadening that universe, and we need to make sure that trust and security expands to the rest of the universe. And so, for example, I know CFPB is thinking about how they would extend their own supervision authority, and I think those are really positive things because, while open banking, open finance is great for consumers, you need the regulators to be paying attention because there's all sorts of businesses out there. Hopefully most of them are great businesses, but sometimes they're not going to be, and that's what regulators really will help us with. And the third thing is this point about competition that Tom was just talking about. I mean, Tom made several great points about why it's important. I would just focus on one thing. Before there was competition, you didn't see a lot of innovation. People were kind of stuck with one provider. I mean, look, 15 years ago, there was no bank app that you can use like you can today to do things with your money. If you wanted to pay a bill, you used a check. If you wanted to do it quickly, you'd have to drive to the place and drop it off. So it's amazing how far we've come, and there's a lot more ahead. So I think the competition aspect is very, very significant.
And Sharon, add to this, and also you are bringing a perspective you're based in the US, but you are with a British company and previously were in the UK, where there has been a lot of experience with open banking and the goal of more portability of accounts, which I think did not turn into a flood of people switching accounts, as I understand it. But share your perspective and, again, what you all are hoping will come from this process.
Yeah. I think the thing that didn't work so well in the UK was that not everybody signed up for it, and not everybody provided the data in a way that was accessible and made it easy to share. And the best way to solve that is to mandate it. And if regulation can help to force banks to do this, then that's a really good thing. And that will trickle through to many of the themes that Meredith was mentioning. I think I totally agree with. And I think they're the things that should come from this, which are consumers trusting the system and trusting that if they share their data, nothing bad will happen. In fact, actually something good probably would happen because they'll have more choice or more visibility of options. And then actually that ability to use those other options. So the example of people not switching their accounts in the UK, one of the other big reasons for that was that it's really hard to do it. So really hard to switch over from one bank to another, move all your direct debits or all your payments, look for all your history, like all of that stuff. Open banking didn't really help make that any easier. So making it trustworthy, but then making it low friction are the two really important outcomes. And then if we can do that, which probably will take a long time and is not a small challenge, the bit after that is actually using the system should be easier if there's a good open banking standard. So helping people to make payments quickly and easily, whether they're logged in on one or two apps, those sorts of things. So payment initiation, that's probably the gold standard that would come after those other things. But I think the trust bit is really important. You really can't go any further without that because customers won't use something if they don't trust it. And if they trust it, but they find it incredibly hard to use, again, it's very unlikely that they're going to move away from the default, which is the bank they got when they were 16 or 17 or when you first get your bank account.
We want to talk a bit about partnerships, bank fintech partnerships, and their role in the evolving ecosystem and how this issue may impact them. Including community banks and minority depository institutions, MDIs. And I'll offer my opinion that small banks are not going to be able to compete if they can't innovate and provide the kind of technology people want today. And I'll just put it out there, I think they can't innovate unless they partner with fintechs. For the most part, it's somewhat of an overstatement, but not usually. They're not going to be able to afford Google engineers and such to design their technology. So I think the consumer has a huge stake in these partnerships being able to flourish. At the same time, we know there's a lot of regulatory concern about partnerships, about whether the fintech partner is going to be accountable enough and compliant enough and so on. So for any of you, talk about how you see the impact on these partnerships and what you hope to see, what you're worried about maybe.
Yeah, I mean, I'd be happy to start. I think your point is totally well taken, Joanne. I agree. The largest institutions are able to afford whatever kind of technology they need. And we haven't talked about, sort of the shift to API-based access to data, but this is a good place to bring that in. In the past, data was gathered through other means, through screen scraping primarily, and in the last couple of years, it's really moved towards having an API-based way to access the data and collect the data, which provides more control over that. One of the challenges for the smaller institutions is they don't have the ability to build their own APIs. It's just too expensive. One of the things we've tried to do as a company that is one of those third parties that collects the data is make available technology that they can use, which is essentially an API that they can plug in to do it. So we're trying to make that work because we agree that's what the future is going to be about. And I think it's really important, though, that those small institutions and all of their customers not be forgotten in this process, because if the rule were too prescriptive about specific technology to be used and exactly how it's going to work, it might really shut out all of those small institutions. And, I said earlier, 8 in 10 Americans use fintech apps. That other two people, they probably would benefit from having the ability to have access to fintech apps as well. And so we don't want to shut that off too soon.
And I think I'd add to what Meredith said, all else equal, I think there's a consensus that we should be moving towards an API or some other secure data standard. But that doesn't just require a technological solution, it also requires, certain legal solutions. And what we've observed is, yes, are the largest financial institutions entering into those agreements? Sure, but there's a long tail, and that includes a lot of the community banks, minority depository institutions, and similar. And so one of our goals in this rulemaking is, by resolving a lot of the open questions that are currently being resolved through bilateral negotiations, through rulemaking, you take a lot of that sort of off the table, and it hopefully facilitates everybody getting on board in the ecosystem in a way that is safe and secure and hopefully minimizes transaction costs so that folks can focus on sort of the implementation piece that, that doesn't require the issues that we hope to cover during the rulemaking.
Yeah. Sorry, I just want to add one other thing. Your question, in a way, was a little bit broader. It was about fintechs in general and concerns from the prudential regulators about sort of the safety of those institutions. I think it's dangerous to do a broad brush approach and say all good or all bad. I think that's part of the reason why it's so welcome that regulators are looking at this area right now, because there's going to be great actors and there's going to be some that are not so great. But ultimately, if consumers want this, and if this can be beneficial for consumers, either because ease or access or whatever other reason, then it's up to industry and regulators to solve the problem and provide it for them.
Yeah, I think so. The topic of the smaller banks is an interesting one. So that's something that we don't have so much in UK and Europe. It's much more fragmented here. And the role of partnerships there, I think, is probably actually really, really big. And we've partnered with a couple of credit unions, smaller ones here in the US, to help them with their international payments. So that's our business. We're not probably going to be the partner that solves for domestic payments for these smaller businesses, but we absolutely want to make our service available to as many customers as possible. And we wouldn't discriminate based on you being a big bank or a smaller bank. And we've proven that by integrating with these smaller credit unions already. So that's an interesting one. I think the role there on the fintech is to make their ability to integrate as easy as possible and take away or give those smaller organisations an option to sort of outsource stuff that they can't afford to build for themselves. The role of open banking there, if it went down the route of mandating very strictly what those smaller organisations had to build, that would probably be quite concerning for them because they don't have the ability to build that sort of stuff themselves. So how you include partners in that legislation. So having the ability for a smaller credit union, for example, to leverage a partner to meet those requirements would be maybe one way to think about it. But it's an interesting topic. I mean, the nature of open banking, I think, is about enabling people or not shutting them out of a system. And if you didn't enable smaller banks or institutions through doing it, then it would feel like it had failed. But it's an interesting challenge. It's not. I'm not sure what the answer is, but I think any legislation that comes through should acknowledge that, and it certainly shouldn't work against that because that just feels wrong.
Tom will figure out all the answers. Is that right? This is such an important topic, and I know that Rodney Hood will be the next speaker and talk about the credit union component of this challenge. And if I can put in a plug for it, my organization, AIR, is holding a conference on November 30th on minority depository institutions and digitization and how to make them competitive, working on these issues with the National Bankers Association and Inclusive and other partners. Meredith, back to you. You've already talked to the large themes that are in play here, but distill for us again the main things that you really think need to get right in this process in order to benefit the consumer to the maximum degree.
Well, I mean, I keep going back to the consumer. Not surprisingly, my history has been doing a lot of consumer protection work in the past, including at the CFPB. And so I think trying to think about what the consumer's needs are, which is safety, security, but also the innovation, and access, sorry, are the critical things. And that clearly should be the starting point, I think, for the CFPB. One of the challenges that I know that they're grappling with is what do you do about privacy and control of data once it leaves the consumer, either to go to their bank or to go to the fintech or to go to whatever other company it is. And I think that we don't really have a national consensus yet on sort of how to treat data, but I think that there's room for that. And it's really important that that kind of regulation be nuanced, because it's so easy to be like super, super protective. You've achieved protection, but you've failed in the space of allowing innovation or improving the experience or the ease for the consumer. And so one of the things that we've been talking about at my company is, what do you do about secondary uses of data? And we've kind of come around to think about this as, when a consumer wants to have a service or use a product, they're consenting to a certain, bunch of uses for their data to make that possible. And for that, you need to give notice, you need consent, under the typical standards that exist. But, you can start to think about things that go beyond that and think about opening up consumer consent and giving notice in new ways when you're getting beyond that. And that's not something that we've agreed to yet as a society. There's not a law that requires that, but it's probably a direction that things are going to have to go.
I will offer my 2 cents that I think we need to develop a whole new model of consumer protection and disclosure, because our traditional disclose and consent model, how do I say it nicely? It doesn't work all the time. Sharon, let me come back to you for a minute. You talked earlier about the differences between the US and the UK in terms of open banking. Help us look more broadly at the context of privacy protection and data use and data rights. The US has definitely done much less in this area legislatively and from a regulatory standpoint than most other parts of the world, really, and certainly the UK and Europe. And when we begin working in these issues, we tend to define them as financial because we're in the financial space, but they're way bigger than finance. What lessons are you seeing from GDPR and the other things that have happened, PSD2 and so on, that might benefit this discussion?
Yeah, I think one of the really good things about GDPR is just the awareness that it's brought to consumers. It was a huge topic. So, anyone working in any industry that involves data would have known about it, but customers also, because it was such a headline news story. And that's a good thing. So, having it as a debate and having it as a topic that's on the agenda is a really good thing. But then the implementation of it is quite different. And this was not something that had ever happened before. So it came in and there were no GDPR experts because it was a new thing. And so the implementation of it was really variable. And my experience as a UK person is now every website I go on, I read this huge bit of text and then click a button that says, yes, I want to keep going. Yeah. And I don't read the text. And arguably, that's not really solving the problem that it sets out to solve. So finding some balance between that and complete free-for-all, Wild West, whatever, is probably where to go. And if people can learn from what the GDPR implementation looked like, and there are now experts, right? There's people who've worked on this for a number of years and probably do have a better opinion now on what we should do than when we were actually trying to roll it out. And one thing I think we really didn't do well is the customer experience part of it. So my example of, I don't read the small print and before I click the button, but also when you're trying to use some of these, using the fintech example, because we were talking about fintech, it can make your product much harder to use if you don't instantly give that access to the data. So if you want to send some money to a friend, if you use Venmo, you need to give permission to find those friends. And finding a way to balance that without doing something bad with that data or taking people's choice away is probably the bit to focus on, in my opinion. There's obviously bad actors who take data and do really bad things with it, and that's probably a different solution to the everyday one. It's try and keep out the bad people who are really going to exploit people's data. That's one set of tools. And then the other one is how do you actually enable people to use things in a usable way by sharing their data? Because people want to do that. I want to do that. Like, I know the risk of sharing my data, but I still don't want to click 20 times before I send some money to somebody on an app. So
We only have a few seconds left. Tom, why don't we give you the last word? What would you like everyone to take away from this session?
The first thing I'd like everyone to take away is please go on our website, download the Sabrifa outline, read it. There's a high-level summary we provide to try to distill it down to the key stuff. We have a public email inbox for people to provide feedback. We want that feedback. We want that stakeholder engagement. Frankly, we need that feedback and stakeholder engagement. And the last thing I'll say is, Joanne, you said something about me figuring this out. There is an incredible team of lawyers and market experts and economists on our rulemaking team,
And technology people.
and technology people. Yes, and I'm just very proud to represent them all, and I'm really building on their work. They're doing the hard stuff. I just get to sit here and tell you all about it.
Thank you. Join me in thanking the panel.
Please welcome Angelina Bradford, Head of Policy and Government Relations at FTA, joined by Rodney Hood, Board Member and former Chairman of the National Credit Union Administration.
Hello. Thank you all very much. First, let me just say thanks so much for sticking with us into the afternoon. We are very excited about this discussion and having Rodney with us today. I will just give you, as you heard, he sits on the NCUA board, is the former chairman. He's actually served on the NCUA twice now. This is his second time becoming chairman in 2019. In his capacity on the board, he also is a representative for them to Neighborhood Works America. He also has private sector experience as well. As the corporate responsibility manager at JP Morgan Chase, as well as work at other financial institutions and the Department of Agriculture. So we're very excited about this conversation. I'll tell you, as I was reading your bio, I took away a couple things. One, we are actually alums in two different cases, one from the Bush administration and then one from traditional finance. So Amazing. We find ourselves in a very unique environment today, and I think are excited about the conversation on fintech. But most importantly, I think what I took away from your bio was really your public service, both in the public sector and the private sector. And I think that really speaks to you. And also, I'm looking forward to having this conversation as a result of that. So thank you so much for everything you've done.
Angelina, thank you for hosting this panel with me. Penny, hats off to you and all of your colleagues at FTA for convening this first Fintech Summit. I must tell you, I'm very pleased to be here for a number of reasons. One is because it gives me an opportunity to underscore the important role that I believe fintech plays in our credit union system. I look at fintech as perhaps the most important thing credit unions can do to serve their members in today's dynamic marketplace. I think pre-pandemic, a lot of us thought of fintech, oh, isn't this nice? Isn't this a luxury? It is a strategic imperative. And when Angelina was talking about the work that I've done, that sort of from all of my days in financial services and agriculture, and by the way, that first role in agriculture, I was a Bush appointee. I was the Deputy Administrator of Housing within the Department of Agriculture. So we're looking at affordable housing and financing, in case you were wondering if I had this farming sort of background before my career in financial services. But you all, I've always wanted to help marginalized, underserved communities. And if credit unions are going to be able to serve their members in today's environment, they're going to need to use technology, especially some of the smaller institutions that are there. And I told Angelina I would give you all a little bit of a primer on NCUA, because I don't think many of you know who we are as a regulatory entity. NCUA stands for the National Credit Union Administration. We are one of the financial regulators here in Washington, D.C. We work alongside the ranks of the FDIC, the Office of the Comptroller of Currency, CFPB, and the Federal Reserve. Our specific remit is to ensure the safety and soundness of our credit union system. We set the regulations, the policies, and we also have a bit of a bifurcated role in the fact that we not only do policy making, but we insure deposits. So that is the role that we have that's a lot similar to that of the FDIC, in that we are insuring deposits up to $250,000 per account. The thing that I would like for you all to leave here with is credit unions have continued to grow amid the pandemic. We now have credit unions that represent 132.6 million members throughout the United States. We have a little under 5,000 credit unions that are, again, around the country. Our largest credit union is about $130 billion with offices in 25 different countries. And one of our smallest credit unions is about a $200,000 credit union that's in the basement of a church that's only open on Sundays. So there is a full panoply of diversity within our credit union system. And the one thing that I want to do as a safety and soundness regulator, I want to give them the regulatory empowerment and flexibility that they need to serve their members, to live out their mission. By the way, the credit unions are very mission-based. Their ethos that stems from the Great Depression as people helping people. And I, as a forward-thinking regulator, want to give them all the tools that they can embody people helping people. And I think fintech is one way that they can do it.
Well, thank you so much. And I think, we all share that view, I guess maybe is a good way to start the conversation. Let's talk, a little bit, delve a little deeper into that. Maybe two questions. One, how do you really see the future of fintech and credit unions working together? But also two, how are you focusing on innovation within NCUA?
Good questions, both of them. First of all, you ask about the future of credit unions and fintechs working together. Well, that future is already here. They are doing that now. They are already, in fact, there are many fintechs, some of them who are here with us today, that are working with our credit unions to give them the access to quicker opportunities for loan originations, better opportunities for ferreting out data to see how are we going to be able to provide this small dollar loan to someone who's just beginning their credit journey. Otherwise, if they don't use some of the tools, we leave many Americans vulnerable to pernicious and predatory payday lenders. So credit unions are now able to work with fintechs. We're helping them with a number of tools. Credit unions are also, I'm very proud of the fact that they are pretty much meeting with me often saying, when can we do more? And what do I mean by that? The credit unions want to know, how are we going to give them more regulatory empowerment and flexibility? So one of the things that we're looking at NCUA is how do we provide credit unions with the opportunities to invest de minimis amounts in some of the fintechs that are in our community now. What are we also doing? From the moment I came to NCUA, Angelina, and if anyone knows this in this room, it's definitely also Joanne Barefoot, as I have always wanted to pursue a fintech office. So I'm very proud to let you all know that NCUA will be opening up its fintech office, I hope by the end of the year. And I'm very intentional about it being called the Office of Innovation and Access. This is not innovating because, again, it's what all the cool, glamorous folks are doing, but I'm looking at it through the lens, through the proper deployment of innovative tools, we should then be able to spur greater financial inclusion and access. That means that those 40% of American households who can't obtain $400 in an event of a family emergency, well, now we're hoping to give them the tools that we can do that and get there to pull that intervention before they go to the payday lender. Or those 45 million individuals in America who are credit invisible. How do we use technology through our new office to reach some of those? And if I can, a little bit of a sidebar, when I talk passionately about financial inclusion, it's undergrounded in the fact that I look at financial inclusion as the civil rights issue of our generation. It's a civil rights issue in the sense that without a credit score, many of our individuals that we know every day, here in Washington even, they can't get the job of their choice because they don't have the appropriate credit score. They can't live in the appropriate apartment or house, and that determines then where they get to educate their children. And in some instances, it means that they are just, again, left in this viral spiral of just not having access. So when I talk about it being a civil rights issue, it's because of what I've seen fundamentally. So the FinTech Office of Innovation and Access is going to be coming. I'm hoping, by the way, we announce the candidate soon. I was wanting to do it today to have something newsworthy, but as you know, we sometimes have to be a little more methodical in government. With that being said, the office, though, is poised to open, I dare say, by the end of the year. And it's not going to be an office that is going to stifle creativity. What I want this office to do, from again, sessions with the folks at AIR, with meeting with some of my counterparts at the Financial Conduct Authority and beyond. We want regulatory sandbox opportunities. We want to do tech sprints. We want to look for opportunities to find ways for the credit unions to have these synergies with the fintechs. So again, it's through partnerships, and I cannot wait for this office to come into existence. And by the way, I was very proud of the fact that other regulators have too mentioned their efforts to have offices of innovation. You all probably read here that the OCC is going to enhance its Office of Technology. Also, Federal Housing Finance Agency, another regulator, they are also having an Office of Innovation. So as we all are pursuing these opportunities, I think it just shows that there's a willingness in Washington to think forwardly. I think there are many people who don't think that the regulators are doing enough in this space, and I would counter that, hey, look at some of the things we're doing now. And I think another idea that I would have is I'd like to get the financial regulators to do a panel such as this, where we all talk about what are some of the things that we're seeing and doing within our respective agencies.
Absolutely. No, and I think, really NCUA, at least when I talk to folks in the audience, has really led the way when it comes to fintech and fintech partnerships with credit unions. I know I was speaking with someone during one of the breaks, and they said, by far credit unions are really partnering with fintechs in a, expedient way, as opposed to, say, the smaller banks. And part of that is, I think, because of the regulatory tone you have said at the top at NCUA. Can you delve a little deeper just into how within NCUA you're really trying to cultivate knowledge around fintechs?
That's a really good question. Cultivating knowledge by bringing in outside speakers and experts to talk to all of our examiners, to talk to our risk team, to our general counsel, making sure that we're sharing best practices and papers such as been originated by the Alliance for Innovation and Regulatory Affairs, AIR. Also, you all recognizing that the fintechs are not waiting for Washington to keep up with them. They are really operating at the speed and sound of business. So at every moment, once a week now, I launched a few months ago a fintech discussion series where we bring in the fintechs that are working in partnership with credit unions to our agency to walk us through not their business plan. I have to tell them, this is not your chance to pitch. We're not Shark Tank giving you funding, but what we are wanting to do is to make sure that we understand your fidelity to consumer protection, fair lending, fair housing. So in doing that, our regulators, our examiners, they now have a better understanding of who the fintechs are, and we look at them as third-party vendors. So we're bringing them in, and you all, these are 30-minute conversations, about 15 minutes of presentation, 15 Q&A. And then if the examination team wants to do a deeper dive, we bring them back in. But the main thing is wanting them to know we're not here to micromanage your business. We're not here to tell you that you shouldn't work with credit unions. We want you to know that we have a very forward-thinking approach, but at the same time, we want to make sure that you are looking at consumer protection. That is the main thing. We've been doing them every week, and I will continue to do them because I think it's the right thing to do.
Absolutely. No, and I think, it's refreshing to hear that focus I'll say this, within a federal regulator. I think most folks know I come from the traditional banking sector. And so, I think it's laudable for that. One of the other things, you've talked a lot about diversity and inclusion. I know in our prep discussion and also in my reading before, you had a very powerful statement op-ed that you put out, and then around George Floyd's unfortunate death, and really with a focus on really creating opportunities within communities. How are you focusing on that right now, and how do you see fintechs really helping to lead the way there?
Another good question. And what Angelina, she's referencing is we're all working remotely during that tragedy concerning the death of George Floyd. And I'm sitting there, and what many of you may not know, I became, when I was announced as chairman of NCUA, it's the first time a man of color, or a person of color for that matter, has ever been the chairman of a banking regulatory entity. So when I became chairman, I said, you know what, I get to look at a lot of different opportunities now through the lens of how I know being black has shaped me, and to see what happened to George Floyd, I wanted to do something demonstrable. I wrote an op-ed and placed it in the Wall Street Journal where I talked about banks and credit unions coming together to promote financial inclusion. Again, I mentioned it as a civil rights issue, but I talk about how they can come together to provide resources, whether it be financial health, financial capability, loans, small business capital. So that was one thing that we started. And then following the op-ed, I really wanted to do something other than just do a bit of writing. So we created a new entity within the NCUA. It's the Office of Access. That stands for Advancing Communities Through Credit, education, stability, and support. And this group is going to be faced with working with a lot of you here in the fintech world, but looking merely through the lens of access and affordable lending and things of that nature. We also are going to have this person work with our MDIs, our minority depository institutions, also helping us with recruiting. How do we recruit a workforce that resembles the communities that we wish to serve, but also being that liaison to credit unions themselves and helping them with their diversity, equity, and inclusion activities. One thing that we're doing, Angelina, with this group, Access, it is going to rest within the Office of Innovation. So that's where we're going to have our fintech person, our head of access, all working in partnership around innovation and access. We at NCUA just also had our third annual DEI Summit. When I again was chairman, I got so emotional on the stage. I said, we should do this each and every year. We are doing it each and every year. And we just had our third summit, but we did something a little different this year. We now coined DEIA, so the diversity, equity, inclusion, and access. And on that panel, we were able to really demonstrate some of the things that need to be done with fintechs around how they can help us with marketing, outreach, but also you all in helping differently able or disabled communities. That was a point of mine when I think about diversity. I look at it very expansively. I know we tend to look at it through the lens of ethnicity and race, but from both of our days in traditional finance, I tend to look at low to moderate income. I look at rural communities, tribal communities. We mentioned disabled. What about veteran families? These are all the components that I think that we need to look at when we look at DEI and now A issues. So that was really interesting that we were able to have a broader discussion around how financial inclusion can work through fintech. And we had a number of fintech folks there. So
wonderful. No, that's fantastic. I mean, I know just sitting here and also looking at the audience, I know a lot of us are really moved by this focus and by the work that you're putting behind the words. How can the industry engage in this effort and meaningfully assist in really making a difference?
That's a really good question. Well, one way that I think the industry can engage is by letting us know what it's on your mind. I get letters, I get emails, I go to a lot of convenings such as this, and you all, I can only move forward with our agency and with our industry by knowledge. And again, this is not for the faint of heart, and it's so important that you're getting great knowledge, that you're going to convenings. I also like the fact that sitting where I sit, I get to talk to regulators all over the globe. I know you were just in Singapore. I was just in London where I was able to meet with the Financial Conduct Authority, the Bank of England. You all, the body of work that's coming into the space now is plentiful, but we need to make sure that we're reading and talking to the subject matter experts. I know one of the ways for continued engagement, at least from where I'm sitting at NCUA, we put out a lot of rules around, we ask for comments. If we're going to do an advance notice of proposed rulemaking, you can let us know what are the things that are on your mind. I certainly, for one, who believes that regulation needing to be effective and not excessive, I want to hear from you all. I want to make sure that there are not these unintended consequences that come about through maybe things that we may do as a regulator. So I want to hear from you all. We also are looking at maybe doing more town halls. In fact, this new fintech director, I guess you're thinking, when is Rodney going to let him rest or her rest? But I want this person to do some town halls. And again, that's something that I know the Federal Housing Finance Agency is doing as they build out their new groups. I think we too should maybe do some town halls. In this town, imitation is the best form of flattery, by the way. But I'm looking at, so you all, there are a plethora of opportunities for you to engage with us. And then you have people like me who are just, again, it begins with relationship building. And I hope today that some of you that I've not met in the fintech space, that I'll get to know you all and perhaps invite you back to present to our agency.
No, that'd be fantastic. And I think, I actually have two follow-ups here based on that. So, this could be an endless conversation. But, I think this is really great for all of us to take back and figure out how to be, the most helpful to you as you continue this mission. You mentioned going abroad and talking to some regulators who, arguably are maybe a little further along than in some cases we are here in the United States. What were some of the lessons learned from that experience, at least from you in those discussions?
That really is a good question. I would say that from my conversations in the UK, they were really among the first to pilot the whole concept of the regulatory sandboxes, getting together in the controlled, structured environment to look at the technology, but how do you find opportunities to really address some of the regulatory impediments and hurdles before that product or that invention is scaled. So those are some things that you want to start early and work with them through that lens. Another thing that I've learned, you all, and this in fact wasn't abroad, but it was something again at one of the AIR opportunities, and that was as we build out our new office, let's make sure that we have legal counsel who is able to look at these opportunities through the lens of technology moving forward. We tend to find that traditional legal frameworks may not necessarily embrace technology to the degree that we'd like. I think that was pretty diplomatic.
Yes. You did a great job.
So with that being said, so those are some of the things that I've learned locally, but the main things, and also you all from talking to some of the regulators in India, what I've learned from them is you all, they've been so advanced with payment systems and able to use technology by way of everyone there. They can be so remote, but yet tethered to one another through being able to do payments. And I mean, this even predates some of the other things, Venmo and Apple Pay. These are things that I've been able to see. So you all, I don't think there's ever been a better time to explore technology, to look at its use cases. And it's not to say it doesn't come with risk, but again, I believe that we should always look to mitigate risk as opposed to just avoiding the risk. So just make sure we identify what those risk points are. But the main thing that I've learned from traveling or even staying here locally, there's a willingness to share. The fact that I will sometimes read something, either the Financial Times or the Wall Street Journal, I'll just call the writer, I'll call the person, and next thing you know, we're talking about, what were you thinking about this? How did you think about building out your shop here? So again, I think the one thing that unites us in this space is that we're all in it together. I don't think, at least to my knowledge, I've not seen any fiefdoms or anything like this. It's been this wonderful sort of sharing of knowledge and wanting to grow.
Absolutely. No, I think that's really helpful. And I think, our previous panel, just to touch on this quickly, talked a lot about open banking and, the CFPB's proposal that's out there. I mean, sort of curious if and how the NCUA has engaged with the CFPB on this, or just engages with regulators generally on some of these kind of key issues.
Of course, and it's a FIREA, again, that's the Financial Industry Regulatory Enforcement Agency. So I'm trying not to use the labyrinth of alphabets before you today, but we work in tandem with all the other financial regulators on a number of matters, and of course with CFPB. Our remit, when I talked about what we do at NCUA around safety and soundness of credit unions, we have our own consumer protection division, with the exception of those credit unions that are above 10 billion. So they are the ones who have full opportunities to work with the CFPB. With that being said, we work a lot with them. A lot of the rulemakings that we do in tandem with them. Regarding the open banking, it's one of the things that, of course, we get to meet with them, talk about what our opinions are. And again, as with many of the others that work in regulation here, it's about being stewards of the resources we've been entrusted. We want to look after our members, we call them in credit unions, banks, they want to look after their customers. Again, safety, soundness, consumer protection, fair lending, all of those things that we want to see. So yes, we work quite often with CFPB. We also work with them with the Credit Union Advisory Council that they have. I don't know if you all realize that, but CFPB does have a Credit Union Advisory Council. The Federal Reserve also has an advisory council where they meet with their entities. So again, one of the things that I don't know if people outside the room recognize is that the regulators work together. A lot of our rulemakings are done in partnership. One thing that we do in partnership is that we just put out a request for information regarding how are banks and credit unions using artificial intelligence and machine learning to help with BSA compliance. So that's another example of how we work together in partnership. So no one, for the most part, is working in a vacuum. I don't think you can these days.
I think that's fair, especially in DC.
No.
I think you have to have a group of people to get anything done.
Exactly.
But I think you also know that the moment we start talking about AML, that's also something that I focus a lot on and have focused a lot on in my career. Mm-hmm. We think about AML in two ways. I think from a tech perspective broadly, there's a lot of gains either from compliance or bankability. That I think that technology really can provide an opportunity for. Mm-hmm. Particularly as we think about know your customer requirements, and maybe where technology can help us do better at knowing our customer, but also getting to the and underbanked, universe, how are you thinking about these issues and other issues as we look at implementation of the Anti-Money Laundering Act of 2020?
Well, first of all, we at NCUA have always had an internal working group looking at the Bank Secrecy Act. We have a working group that works with FinCEN. When I was chairman, we met monthly, you all. There is no other group that I know of that has a monthly meeting with the regulators to address any particular topic, and it was around BSA. FinCEN we work with quite heavily. Regarding a lot of the AML work that's going on now, especially around the new announcement around the AML Act of 2021, we have a working group that's looking at any of the rulemakings that are going to need to come forth from it. Many of you know that there is that Corporate Transaction Act. That's going to require 3 separate rulemakings. So we are working quite collaboratively with the other entities. Also, you all, we do a number of training sessions on BSA. We have workshops on it because, again, it's one of the things that I would say, second to cybersecurity, BSA and AML compliance is another one of those areas that keeps me up at night. I would be remiss if I didn't mention the fact that we have also invited a lot of the law enforcement folks in that look at our BSA and our CTR, currency transaction reports, and suspicious activity report filings. They come in and train our examiners on what are some nice ways to fill out the reports. We train the credit unions on what are some of the things that can best assist law enforcement when it comes to capturing the bad actors who want to do us harm. So we do an ongoing training session. In addition to that, we have a critical infrastructure security group within NCUA. They are helping us come up with a rulemaking. The other banking entities are doing this as well. What's going to be the rulemaking around 48 hours to 72 hours when there is a severe cybersecurity breach? So that's one of the things that you're going to see coming out. And by the way, you all from the credit unions, we have that out for comment now. So let us know, what are your thoughts on the 72-hour rulemaking? Some have said that's about right. Some have said longer. So we want to hear from what you all have to say regarding that. But going back to the question at hand, AML and BSA, they have been always a part of our supervisory priorities. As you know, each year we sort of give the industry, what are we going to be looking at this year? Well, the one thing that has remained constant, even from when as you mentioned in my introduction, even when I was on the NCUA board over a decade ago as vice chairman, BSA was on it then, and it's going to remain important. One of the things you all, if I could get your help with, is how do we better deploy technology to make sure we are really helping to onboard our credit union members? Are we really doing an effective job around knowing your customer and complying with it? I've met a number of fintechs that are working with digital identity and things of that nature, and I want to make sure that we are doing all that we can. So that's been an area that I really want to start leaning in on a little more. You've heard me mention about financial inclusion. By the way, sidebar, we just did a credit union quasi Shark Tank Light event. I have to give it light because if I say Shark Tank, I could be sued. So Shark Tank Light event, where we had fintechs talking about financial inclusion and their tools around financial coaching and how to help with different savings accounts and things of that nature. What I'd like to do, y'all, in the future is maybe do one around digital identity and see what are some of the tools there. Because in the onset of the introduction, I mentioned 5 million new credit union member owners during the onset of the pandemic. Well, yes, I'm wanting them. I know that they've done a good job with KYC and all that, but how do we even make it even more streamlined? So that's one area that I think we can work with our fintech providers.
Absolutely. No, I think that's so helpful. And I know, from my past experience, in the banking space in particular, the rules were written in 2003. That's not the way we interact with any financial institution anymore. So I think I totally agree. There's such a scope there for us to move forward. And I know the other thing you mentioned that keeps you up at night is cybersecurity. You just published a Bank Think piece on that. How are you what's your message not only to credit unions, but also to the fintechs they partner with? And how do you think the relationship between credit unions and fintechs can help enhance the cybersecurity efforts within a credit union?
Well, I think the main thing that I would say is with cybersecurity, I tell folks that it's something that we need to be mindful of. Again, how are we going to mitigate risk? How are we going to batten down the hatches and make sure that we are doing multi-factor authentication? How do we make sure that all of your employees who are working in these regulated entities understand how to safeguard information? There are a number of fintechs that I have met with you all that are doing the cybersecurity tools that they have. We at NCUA have a cybersecurity assessment tool that we've rolled out. But the thing is, I think the fintechs that we're working with now, they recognize the importance of cybersecurity. So that's the one thing. I've yet to meet one who hasn't thought about this as a challenge. And it's because they are in this space and they know the vulnerabilities that are there. But again, what we're doing is, I tell folks, as I mentioned in the op-ed, let's look at your whole profile of your organization. When we examine credit unions for cybersecurity, it's not a one-size-fits-all approach. We're going to look at what are the tools and resources you're using for a credit union commensurate with your size and complexity. We also want to make sure that, are you doing training sessions? Are you making sure that you're keeping everyone up to date? Also in the op-ed, I mentioned to folks that they need to make sure that they're able to communicate with their regulators, whether they be the state chartered entities that use us for federal insurance, or even our federally chartered who come to us for everything. Let us know when there is an issue. Again, why the whole piece around the critical infrastructure, the rulemaking around the 72 hours, that's something we want to make sure that we're communicating. And then lamentably, you all, I did have to, and I do tell folks, what is your strategy going to be, not for if you are hacked or if there's a breach, but when? That is not the time to hide, but that is the time to really make sure that you have an effective communication strategy to let your members know what has occurred and what you're doing to remediate that situation. So again, communication, ongoing training, as it relates to the fintechs, just when you are meeting with us and your other credit unions, let them know about what you are doing to safeguard the data, but also to try to keep the bad actors at bay.
No, absolutely. And I think, I think we all are in that fight together to really keep the bad actors at bay, as we think about ransomware and other national security threats. As we kind of have a few minutes left, want to zoom out a bit, just a moment. We're not on Zoom in person here, but and talk a little bit about last week's election. And I'm curious, sort of, for your views. You've served distinguishedly and for years now, and under many different administrations. And so, from that perspective, how do you see sort of the NCUA interacting with Congress in the next Congress, and how do you see that sort of impacting fintech and credit union partnerships?
Well, you know what, that's a really good question. And even though I'm appointed by the president, confirmed by the Senate, I don't know if I can really speak about anything regarding last week's election because it's not over yet.
Yeah,
so
fair.
I don't know what the results are. So with that being said, I say that tongue in cheek. But what I will say, you all, no matter what elections take place in our society, the credit union system, the banking system, I try to tell folks that we are not partisans. We are here, safety and soundness. It is to undergird the American economy. It is to, and my remit is to make sure that I'm giving credit unions the policies that they need to serve their members, and to do so with a fidelity to consumer protection, consumer compliance. Are they able to go out and serve underserved communities? Are they able to embrace technology? So yes, there's an election, and yes, we'll have some new members coming to town, but at the end of the day, if we as regulators are doing our job appropriately, we are focusing, again, the economy and what role we play into making sure that there is a safe marketplace for folks to do business in.
Absolutely. And I know we are almost out of time. So let me ask you, do you have any final words of wisdom for this group?
Well, this is such a wise group. I will just say that thank you for allowing me an opportunity to come and share with you my thoughts as a regulator on the role that fintech plays with our credit union system. I would say this to you all, I don't look at it as a luxury. It is indeed a strategic imperative. When I mentioned that $200,000 credit union in the basement of a church, that entity is not going to be able to go out and build a digitally native platform or go out and buy software, but what they can do is work in partnership with credit unions and other fintech providers here. So credit unions get to work in partnership, and I just want my policies to enable them to do just that. There are 132 million people expecting me and my industry and agency to do the right thing, and I certainly give you all my word that I will do my level best to provide opportunities for hope for the folks who need a bright future financially.
Well, let me just say thank you so much. I think I have to amend my statement from the beginning and say not only are you an amazing public servant, but you're also a constant learner. And we thank you for your service and for joining us today and your remarks.
Thank you for
really
a great panel.
It.
Thank you.
Introducing Protocol's Owen Thomas to lead a conversation around the state of fintech, joined by Kate Cox of Protocol and Victoria Guida of Politico.
Good afternoon, everyone. I'm Owen Thomas, Senior Editor for Protocol, for now. And I'm delighted to welcome you all here to the FTA Protocol Fintech Summit. I'm going to be taking you through the 2023 Fintech Outlook. I joined Protocol in 2021, and it's a massive understatement to say it's been a wild time in the sector we cover, and for Protocol as well. But we're here to talk about you, not me. Next slide, please. So I think we're all feeling this a little right now. And that's because, next slide, please. 2021 was an outlier year. It was not a normal year. 77 fintech companies went public. 20 of those were SPACs. Remember SPACs? They had a good run. $100 million rounds, massive valuations. And this is most startling to me as someone who's covered venture capital since the 1990s. More than a third of global venture capital went into fintech. You had fintech founders dominating YC's classes, even fintech-dedicated funds arising in venture capital, which again, from my historical perspective, has been a rarity. Well, next slide, please. What goes up must come down. 2022 has been an outlier in the other direction. Fintech stocks, as tracked by F Prime Capital, crashed more than twice as much as the NASDAQ at large, more than cloud stocks, more than the S&P 500. They outperformed in 2021, massively underperformed in 2022. And then, that's not even talking about crypto. $2.1 trillion wiped out. I'm not sure if that number is even updated from the latest token implosions. And there's probably been another one since this morning. Next slide, please. Add in war, inflation, rising interest rates, and the outlook can seem really perilous. Yet, not all is lost. Even a phenomenon like rising rates can, for example, give neobanks a chance to grab deposits from established players. These changing times do bring some opportunities. If you talk to VCs, they love to talk about all their portfolio companies that were started in the 2008 financial crisis and how tough times create tough founders. Ultimately, though, startups cannot outrun the economy at large. Startups, like everyone else, depend on healthy customers, healthy businesses, healthy consumers. And a downturn is going to have an impact. Next slide, please. Then there's regulation. Just in crypto, there's MiCA, DCCPA, Lummis Gillibrand, which may be dead. The UK, their Financial Conduct Authority, is regulating crypto. Singapore, which tried to welcome the crypto industry to its shores, is now trying to rein it in. So again, don't think that digital asset regulation is not going to spill over into other areas of fintech because they are increasingly interconnected. There is Dodd-Frank Section 1031, open banking, which you heard about earlier today. The SBA is considering reforms to its lending rules that could open up opportunities for fintechs. It could also, depending on how they're written, rein them in. The OCC's increasing scrutiny of bank fintech partnerships, that is something to watch, and I don't think enough attention is paid to that. Lending, credit scoring, payments, it's all getting more scrutiny. That is guaranteed in 2023. Next slide, please. There are opportunities, though, in all of this change and chaos. Financial infrastructure, I'm going to shorten that to FINFRA, and I think I just made that up, so you're welcome, everyone. Put it on your slides. That includes embedded finance, banking as a service. I think that, because it takes costs out of older financial technology stacks, that has a lot of promise right now. Spend management, treasury management, B2B fintech generally, that can be countercyclical to, to times when consumers are struggling. Startups tend to switch to B2B from B2C in recessions. I've seen it many a time. But also think about things like debt management. That is going to be, sadly, an opportunity, almost a social requirement as consumer finances get constrained. Remittances, too, are still taking too many pennies out of every dollar that some of the least well-off households can afford. And so I think that is something where business rationale and social impact can merge. It's something to think about. Next slide, please. With that, I'd like to welcome my colleague at Protocol, Kate Cox, our policy editor, and in the larger Politico media group, Victoria Guida, economics reporter, for a in-depth discussion of the 2023 outlook.
Hi. Hey.
Welcome, Kate. Welcome, Victoria. Thanks for joining me. So, covering the economy and the tech landscape this year, did you kind of feel like that roller coaster slide?
It's been a really boring year. Yeah, no, definitely. And I feel like the broader economy has sort of tracked exactly what you just laid out there for the fintech industry specifically, where, we had a really high-flying year in 2021 when there was really rapid growth, and then 2022, we appeared to have negative growth in the first half of the year. It's unclear whether we've been in a recession at any point, but there might be one coming. But it's the strangest recession that you can imagine if we did have one, since the labor market is doing so well. 3.5, well, now it's 3.7% unemployment, but still very good, still rapid pace of job growth, still, decent consumer spending despite rates going up a lot. So, plenty to unpack.
Policy side's kind of bonkers too. We came into this year, a lot of people who observe what's going on here in the district thought for sure there would be a Republican majority Congress going into next year, and those people are wrong. They were wrong.
Half, maybe.
Well, yeah, it's certainly
still a major curveball.
Yeah, the Senate's sticking with the Democrats next year. The House, probably Republican. It's a real knife-edge situation, right? Nobody has overwhelming supermajorities of anything.
It doesn't take that many resignations or other circumstances.
Right. So, I think some of the bills and priorities you outlined are not going to move forward. I think the Lemons Gillibrand bill is in the wake of some implosions in the past 2 weeks, no longer considered strong enough, and there's going to be strong pressure from Democrats to regulate harder, regulate more, but they can't do it alone, right? There's going to need to find the bipartisan slice. It's a real wild card, isn't it?
Yeah, I think Superintendent Adrienne Harris of New York made that point earlier. She said anyone who's arguing for lighter crypto regulation is not reading the room. And I think that is, I think that's true for other aspects of fintech touching policy. I think that there's been a perception that, this industry's grown really fast and we need to pull it back.
Yeah, no, definitely. And it's been really strange just in the past week, as you all have just been talking about, because it's sort of unclear as to, on the crypto front, whether this makes legislation more or less unlikely, because as you just laid out, there's a question now whether this legislation that's out there is strong enough, but also it might mean, it sort of demonstrates why not having rules of the road is potentially problematic.
Maybe they're legislating the wrong thing, maybe they're looking in the wrong place, right? Almost every rule we have, and not just US policy, but in the world, comes from someone did a thing they should not have done. And after you do it, it's against the rules. And I think folks right now are going to be really trying to spin out, which parts of this should we have said you can't do? Which parts should, the whole permissionless innovation thing, yes, until you crash the sector and take out billions of dollars of wealth, and then maybe some people get mad.
It seems like a divided Congress is going to be particularly tricky for agencies to navigate because, if you kind of know that you're going to get the same questions at a House hearing as a Senate hearing, you kind of steer, you steer that way. I mean, I think we've already seen the CFPB really signal actively that they do want to encourage innovation, they do want to encourage competition, but I think that, in, say, a Senate banking hearing or a House Financial Services hearing, they're going to get, Director Chopra is going to get different questions.
Yeah, in some ways that might make it easier for the regulators because I think that when lawmakers understand the political environment and they understand that the regulators have to deal with competing politics. And so I think if you have a Senate that's controlled by Democrats and a House that's controlled by Republicans, then that sort of gives the agencies more of an out to kind of chart their own path, kind of, a more central path. And, this is something that, it's interesting because I feel like this is something that the Fed in particular always tries to do because it's so concerned with trying to preserve its political independence. But it will be interesting to see how it plays out for agencies like the SEC or the CFPB that are run by people who have been, are inclined to be very aggressive regulators. And I guess if they're getting pressure from the House side, but not as much from the Senate side, then maybe that empowers them a little bit more, especially given that we were just saying, if you're not calling for tougher rules on crypto, then you're kind of out of step with where we are, and I think that sort of empowers, for example, Gary Gensler.
Also, the bigger challenge for the agencies, I think, is the courts. This is something the CFPB in particular, right, has since its inception faced challenge after challenge after challenge. Other agencies, the FTC has faced a bunch of challenges, and so up to a point, you're good. The agencies don't answer to Congress. I mean, their heads do, but there's only so much an oversight committee can do in a broad sense. But if the Fifth Circuit doesn't like your rules, then you don't have rules, or if the Supreme Court doesn't like your rules after that. So, those are really the political headwinds up against the agencies for the next 2 years. After that, who knows?
How important is the message of economic growth through innovation? I think about tech policy during, say, the Obama administration, and that was a big part of Obama's embrace of tech, is that this was going to lift us out of a recession. Tech was kind of, leave aside a social force, it was just an economic force for good. It was a job creator when Detroit and Wall Street were on their backs. Is that going to, is that going to, win over hearts and minds in Capitol Hill, and B, is it, are the prospects for growth real enough?
Yeah, I mean, I think this is, a reckoning, I guess, for fintech, where, so on the crypto side, I think it's sort of a reckoning in terms of what actually is this and how is it useful and what is it just a bubble. In terms of fintech, I mean, there is obviously supposed to be this huge promise of financial inclusion, and if we are headed into a recession, it's unclear, how severe that recession might be because, as I was saying earlier, the labor market has remained pretty strong. But if we do start to see, layoffs really start to pick up, this is something where it seems like fintech might be able to sort of prove its mettle, but this is also historically also the time period when consumers get screwed over. And so I think that, obviously we have a CFPB that's watching these issues very closely. And so it'll be interesting to watch the tension of this is the moment, right? To if we do head into a recession, this is a moment for all of those, economic growth, financial inclusion promises to actually play in. But I think it also, with great power comes great responsibility. That's the quote I was looking for.
I mean, I also think, this is a really good time for everybody in pretty much every sector, but also in politics and governance, to really think hard about what we mean when we say tech. You mentioned the Obama administration, Facebook went public in 2012, right? That's when they bought Instagram and
Yes.
went public, and it was this huge moneymaker, right? They $1 billion, like.
Yeah.
And
No,
they,
I live in San Francisco. It
Right.
definitely boosted California's economy.
and then they just laid off 11,000 people last week.
Yeah,
So-
and that is going to take a
Right.
toll on the downside.
You know, the people I know who have been at Meta, at Twitter, at Microsoft, at Alphabet, you know, when they leave or lose jobs or get laid off or whatever, they still have 15 recruiters in their inbox, like every week. Because, you know, what we think of as tech in the banner headline sort of way, the big companies that really draw federal scrutiny because they have 3 billion users, you know, maybe we're getting to a point where we see how much they do or don't represent the sector. And this might be a moment where there's a lot of opportunity for, you know, businesses that are doing well but are not like literally everybody in the world knows their name to, you know, cycle up and get their chance.
And fintech has some market cap giants, like, you know, still Visa, MasterCard, maybe, you know, maybe still PayPal. I have to check where their market cap is hanging out recently. But a lot of the companies are, you know, are kind of mid-market in the, you know, in the stock market sense. And those companies have contributed a lot to job growth overall. Like, not, you know, there's not a single one of them that's, you know, adding like 10,000 people a year, but you know, but they are, you know, certainly we've had layoffs, you know, Stripe most notably, and pullbacks in hiring, but a lot of the companies are still net creating jobs.
Yeah, and this is where, I mean, some of the numbers that you highlighted earlier about, you know, what's happened with stock prices, that's obviously been, you know, a broader phenomenon, but particularly in tech generally, right? Mm-hmm. And so I do think that it'll be, you know, separating the wheat from the chaff. I'm using a lot of cliches, but, you know, in terms of like, you know, what are actually these good long-term bets, and, you know, what are just sort of things that seemed cool that now have lost all their value. But I mean, as you said, I mean, you know, there's a lot of big names up around here that I'm just looking at that, you know, it seems like a lot of these companies are on the ascent, to your point.
And fintech is a good field for that. I mean, honestly, I've been sitting here on this stage trying to remember the last time I paid cash for something, and I can't. Which, you know, but I'm hardly unique as a consumer. Everything, you know, we crossed the digital economy threshold years and years and years ago, and it, you know, I have a strong background in antitrust, and like this is actually a sector that is competitive still. Where some other parts of tech are not really. I think that's neat. I like competition. I like seeing what it does for businesses and consumers. And regulators also like competition. You know, if no one player is so dominant that nobody else can do anything, then the FTC is like, cool, do your thing. So.
And that has been an interesting trend that we have discussed today on the stage, that, you know, the CFPB, for example, has really talked about kind of consumer benefits of some of the companies it regulates, the benefits of competition, which seems to be a different, Kate, would you say that's a change in tone or just something that's evolving more recently?
I mean, I think regulators like to point to competition where they can find it. You know, it's the carrot and the stick combination, right? Like you can point at a monopolist and say, don't do that. But it's also helpful to be able to point at a thriving sector and say, do this. You know, this is good, we're cool. Like, please do more. I think, well, I can't speak for all regulators, but I think some of them probably like being able to say, actually, look, things are going good. You know, this is good, this is great, things are going well. So, you know, yeah, I suspect they enjoy getting to do that when they can.
Sorry, go ahead, Victor.
Oh, I was just going to say, you know, I think there's always kind of a tension in innovation where, you know, I'm sure that there's often an aspect where what they're doing, what the upstart is doing is better. And then there's an aspect of it where maybe they're just outside the regulatory perimeter, right? And I think it's sort of like discerning what is actually the improvement versus like, are these people just making money because they're not regulated as intensely as some of the more traditional players? And I think you're seeing a lot of that in fintech.
At Protocol FinTech, we've talked a lot this year about kind of the gray areas of regulation. Things like, just to pick an example, earned wage access, where, a company is helping an employee get access to funds that they have technically earned, but because of payroll regulations, they only get paid once every 2 weeks. You could get paid weekly. You could get paid for 3 days. And it's really unclear if that's covered by, wage, like wage and hour regulations or by consumer lending. Is it lending? Is it just payroll handled differently? I think in those gray areas, there's a lot of potential for startups to kind of test the boundaries, but also butt up against those regulatory perimeters. What do you think is going to be the action there in the coming year?
On earned wage access.
Earned wage access and these gray areas generally.
Yeah, so I mean, it definitely seems like for the CFPB that this is a high priority. I mean, it seems like big tech is a higher priority. So maybe just under that tier. But I definitely think that there is transparently more scrutiny, right? They talk about it. They talk about earned wage access. They talk about buy now, pay later. They're actively paying attention to these areas. And even something like earned wage access, it's kind of I was talking about not being regulated the same. In banks, there was a time period when the regulators discouraged banks from doing deposit advance products. And so there's always this tension where, you can actually see how this is a benefit to consumers, but you can also see how there are ways in which people can overextend themselves. And so, I don't think that the CFPB is shy about about looking at this stuff. So I definitely think that this is going to be, continue to be a front burner issue this year or this coming year.
Well, and that's the eternal challenge, right? Is this a new thing because you're doing it differently? Or is this the same thing we told you to stop doing 10, 20, 40 years ago that you just put a new hat on it? And, buy now, pay later, I feel like is a great example because I remember, I'm aging myself, but I remember going to the layaway counter when I was very small with my mom and my grandma, and I was like, this is that, except it's not in the back of the Bradleys or the Kmart. It's the internet. And maybe it is and maybe it isn't, right? Like, that's the regulator's problem to solve. But it's easy to see why these things become such a challenge because you can make strong arguments both ways, that this is the same old, and also that this is new. And I really don't know how that's going to shake out for a bunch of these products. I do think it'll take more than a year or two. I think some of this stuff we might still be arguing about in a regulatory sense when it has come and gone and a whole new sector has come up behind it.
I do kind of laugh when I find myself reading laws that were literally written in the 19th century for retail time sales, as they were called, predating all of the modern consumer credit laws. And yet some really clever buy now, pay later startups have figured out how to get the time sales laws rather than, modern consumer credit to apply to them.
That is clever.
They're taking the Sears Roebuck strategy and, fast forwarding it 2 centuries.
Which outlived Sears by a significant margin.
Yes. The economy as a whole in 2023, I know this is one of the most difficult things to predict. Victoria, what are you hearing about the outlook? By the time we figure out if we're in a recession now, are we already out of it?
Yeah, so, no one knows, and actually, one of the things that I think has been really interesting about the Fed is officials, if you listen to them, they say all the time that they have no idea what's going to happen, which I don't know whether that's more or less comforting, but I
isn't that their job, to at least take an informed guess?
Right, but so the reason why they do that is because they want to say, this is what we envision doing with policy, but if things change, because we may be wrong, our policy will adjust. So that's sort of part of the reason why they do that. But yes, it is part of their job. So I mean, and I think the big question, which will shock no one, is inflation and how easily that comes down. It's interesting because we're actually starting to see inflation come down already, which is partially just because some of the supply chain issues have started to work themselves out. Import prices have come down as the dollar has strengthened. So we're starting to see some improvement there, but there are some things like rent that are going to continue to be a problem for a while. And so I think one of the biggest questions is how hard the Fed is going to have to slam the labor market, because if the economy doesn't slow enough on its own, if inflation doesn't start to slow enough just from what the Fed has done already, then they view the labor market as sort of a channel to slowing the economy. So it's one of those weird situations where, heading into the election, the Biden administration would highlight positive trends in the economy, and it's like, well, that's great, but the Fed is sort of trying to stop some of that because they're trying to stop inflation. So, I think it depends on how the labor market holds up and what inflation does if it continues to hold up. Because if we continue to see high inflation and we continue to see a strong labor market, then the Fed is going to feel the need to hit the labor market more strongly. I think that most people expect the inflation problem to be largely under control in, let's say, 2 years from now. But forecasting 2 years out at this point feels like extreme folly.
Nothing matches, right? Like all the sets of patterns that usually travel together are not. And I feel like since COVID really hit in early 2020, I just kind of want to stand on a roof and shout YOLO, and that might be the right approach. Man, I used to feel like I could predict things from patterns and I feel like that's a fool's game right now on both sides of this, right? The actual economic conditions. I don't know, we got a plague and a war in Europe, and those things threw everything out the window. And then in policy, elections are a wild card and actions are unexpected. I think they call it uncertainty.
Yeah, I actually think that was one of the reasons why last week, I think it was last week, time kind of blends together, with the most recent inflation data, there was such a strong market reaction. And I think that one of the reasons for that is that it was forecast that inflation would start easing, some of those goods inflation things that I was talking about. And I think everyone was relieved because they were like, oh my gosh, something that we forecast would happen actually happened.
Something makes sense. Yay! Yeah.
I think one of the problems is that the interest rate levers that the Fed has are kind of, I would compare them to like a floppy accordion. Like they're trying to push one way, but there's so much cash kind of floating around in the global economy that, they call it the global pool of investable cash. It arguably helped inflate the stock bubble, the crypto bubble. There's a lot of money seeking yield. Well, okay, now
could just buy Twitter with it.
Yeah. Nationalize it? I mean, stranger things have happened. But, to the, now the, T-bills are trying to sop up that global pool of investable cash to the extent that it's hitting kind of other parts of the global economy. We see the chaos in the British pound in recent months.
Yeah, no, I mean, a ton of money. I don't know the number off the top of my head, but billions of dollars have flown into the U.S. as rates have gone up, and you've seen other countries have to raise interest rates to try and sort of stem that tide. And so a lot of it is coming into treasuries, into U.S. investments in general, and I think that's probably one of the other reasons why you see such volatility in the stock market is, as you said, there's just so much money out there where because everything is so uncertain, people don't really know where to put their money, but they also don't want to miss the moment because with high rates, there's a lot of investment opportunity.
As I was putting the slides for this deck together, fintech stocks bounced back, changing all the numbers.
And probably as we've talked, they've gone back down again or something. I don't know.
It's back to that roller coaster.
We'll come out of here and look at our phones to figure out who's changing what now.
Yeah. Predicting stocks is probably the worst kind of forecasting to engage in. Well, we're almost out of time. Kate, Victoria, any closing thoughts on 2023 and the outlook?
I think it's going to be a really interesting year for fintech. It's funny because there has been so much focus on crypto lately, as opposed to sort of the other pieces of fintech, and I think it's an open question whether that will continue or whether we'll see sort of a lull in the implosions that are going on here. But it doesn't seem to be slowing down yet. But I guess in the background there still seems to be a lot of work going on in terms of bank fintech partnerships and CFPB rules around these various fintech products for consumers that there still aren't clear rules around. There's a lot of really interesting work going on financial data and how people can use how people can control their own data. So I think that we've been talking about fintech policy for a long time, but I think that this coming year you could actually start to see some of these trends come to a head a little bit more. I don't know whether Kate agrees with that.
I do think, by the time you actually get rules, they're usually pretty narrow. You have to do this with this product and this type of thing. But the inquiries that start there, right, it's a huge funnel. They're very broad. And I think crypto going up rather spectacularly in this past couple weeks is going to draw a lot of other things into the funnel with it. And then, we'll see the next year or two really sort of narrowing what actually comes out of all that asking, of all that inquiry, of all that number crunching, and maybe there will be a giant inquiry with 100 companies in it and a billion CEOs, and it comes down to like changing 6 words of one rule in something. You never know.
Well, you never know. And I think that is a good note to end our discussion of the 2023 FinTech Outlook. Thank you all. Thanks to Victoria Guida and Kate Cox.
Please welcome Dan Gorfine of FTA, joined by Sabrina Howell of NYU, David Quinn of Bluevine, and Connie Evans of the Association for Enterprise Opportunity.
Okay, great. Hello, my name is Daniel Gorfine, and welcome to our panel today, where we're going to discuss a range of topics related to the state of small businesses in the U.S., their access to financial services, and how financial technologies and fintech companies are helping to provide and fill gaps in providing those services. We have an excellent group of panelists here today who bring a diverse set of perspectives and experience who will help us with this discussion. So with that, let's go ahead and jump in. And David, I think I will start with you. So set the scene for us. I mean, tell us a little bit about some of the gaps in small business financing that kind of resulted in the founding of Bluevine. And how are you all using technology to help fill some of those gaps?
Sure. So I think, before we jump in, it's probably important to understand there's in terms of the size of the market, over 30 million small businesses in the US that provide about 50% of the GDP and about 50% of the jobs. So it's a really big market. And those are firms with less than 500 people. So it's a meaningful size. Something that we've seen over the years is that the small business needs are just not being met by the existing banks today. And this is across a number of dimensions. It's across the fact that the fees are high, the service is particularly low, and I think money movement is generally very slow as well. And I would add on top of that, from a lending perspective, we know that only around 20% of those that apply for a loan are actually approved by the traditional banks. So access to capital is extremely limited. So from a gap perspective, this is really the problem statement that we've seen over the last few years. And I think it's been tried to have been addressed by a number of fintechs across the board. You've seen this real fragmentation. You've seen individual lenders pop up. You've seen individual credit cards pop up. You've seen individual firms doing money movement. So they're all trying to provide point solutions. And it's led to a really fragmented market for SMBs. It adds time, it adds complexity to their already busy days. So what Bluevine does differently is we bring financial technology directly to this problem. So essentially, Bluevine is a digital provider of small business banking needs. We provide credit, and we provide money movement and bill pay in a one-stop shop. So we are just purely focused on providing for SMBs. And we do that really for companies between 3 and 20 people, right? So it's really that smaller firm, less than 5 million in turnover, that are non-commercially banked. And that's really the segment we've had, we've heard the most of the issues with these smaller groups, and we've had great success at that. We're reaching a lot of the community in terms of LMI, reaching a lot of communities that aren't traditionally reached by banks using the application of these technologies.
Excellent. So Connie, let me turn to you. You're the head of one of the largest CDFI trade associations that focuses on small business. But for the audience, first tell us a little bit more about CDFIs. What are they? What do they do? And how do they help serve an underserved segment of small businesses?
Sure. CDFIs are community development financial institutions. How many know CDFIs? Oh, great audience. Most of you already know this. So CDFIs, as you know, provide mission-based capital in low-wealth communities based on census tracts. They are certified by the CDFI Fund at the Department of Treasury. There are about 1,700 CDFIs around the country. The smallest portion, one of the smallest portions, are those who are doing small business lending. Some are banks, some are credit unions, some are revolving loan funds, and then, of course, there are some venture funds that are CDFIs as well. We focus on those who are doing small business lending. And again, they're providing not only the capital, but the trusted relationships. That's literally their bread and butter, right? Is the trusted relationships deep in low wealth communities where they can actually reach entrepreneurs, serve them not only with capital, but what we call trusted guidance. And now that trusted guidance may go deep or it may be pretty thin in terms of just helping to get a loan package ready, but it is providing some of the services that business owners are looking for.
Great. And excuse me, let me turn to Sabrina. So you've just heard from Connie and David about access to capital being a key challenge for small businesses. Now you've done some groundbreaking research on fintechs, their ability to reach underserved small businesses during the pandemic period. Can you share with us some of your findings from that research and takeaways?
Yeah, I'd love to. Thank you. So I came to this project motivated by the observation that fintechs brought, I think, two really important innovations to lending. One is algorithmic underwriting using machine learning tools and new data to gauge credit risk. And the other one is process automation. And these technologies raise important questions about their implications for racial disparities in lending. And there's some existing work in economics, I'm an economist, about the role of algorithmic underwriting. But there really hasn't been any study about process automation, maybe because it's less sexy. But that's what we do in our paper. So what is process automation? It's removing the human from the loan origination process, automating application intake, income and payroll verification, fraud checks, even just having a simpler UX with better FAQs so there's sort of less customer service interaction. We are able to isolate the role of process automation by holding fixed credit risk and factors that tend to be correlated with race but are not fully observable, like credit risk, by studying the Paycheck Protection Program, which, as I'm sure most of you know, is a more than $800 billion program to help small businesses in the pandemic. We develop a data set of about 4.2 million first-time PPP borrowers, and we show that more than half of Black-owned businesses that got a PPP loan got it from a fintech. That finding is probably why I was invited here today. And even though fintechs made only about 17% of all the PPP loans, and then among traditional lenders, we show that the rate of lending to Black-owned firms increases with bank size, and measures of bank automation, including actually bank branch level data on software spending, so more automated branches as measured by software spending are lending more to Black-owned firms. So we do a lot in our paper, but I want to just tell you about one more analysis, which is really important because it brings some causality to bear on this question. We show in a set of small banks that automated during PPP by outsourcing the back end, but not the front end of their PPP loan origination to third-party white label fintechs, that after they automated, they increased, roughly doubled the rate of lending to Black-owned businesses. And that analysis is within bank, and it controls for time. And so it has a causal interpretation, and it shows that automation actually increases lending to Black-owned firms. So I'll leave it there, but I'm happy to talk more about that project and other research folks have done.
So you actually have me too interested to, I think I need to follow up on this now. So there's a deep dive that we need to do into the why. So you're identifying that automation seems to have a causal relationship. What is it about automation that's expanding access? Because that's not the underwriting piece per se.
Right,
It's the automated front end, back end that's doing something to increase access. Why?
Yeah, so we explore 3 reasons why automation might increase lending to Black-owned firms. And I should say, by the way, I didn't mention this, but I keep saying Black-owned firms. That's the focus of our paper because that's where the disparity is by far the most striking. So we look at gender and we look at the other racial and ethnic groups, and the really big striking disparities for Black-owned firms relative to actually all other PPP borrowers. So that becomes the focus of the paper. Okay, so why? We explore 3 reasons why automation would increase lending to Black-owned firms. One is that it lowers the fixed cost of making a loan, allowing the lender to make smaller loans, which are then more likely to go to minority-owned firms, which tend to be smaller. Second, automation goes hand in hand with online origination, which allows a lender to serve places that are relatively less well served by the bank branch network and tend to have higher shares of minority borrowers. And then finally, removing the human from the process, from sort of decisions large and small, can reduce the impact of racial discrimination or bias. And we amass a rich array of data sets, partnering actually with some fintechs, including Ocralis, Lendio, and Middesk, to really try to tease out what's going on. And we find evidence for all 3 channels that I mentioned. And importantly, there's an economically meaningful role for mitigating discrimination. So we show that the effect of small bank automation, remember that within bank analysis, is larger in parts of the country with more racial animus against Black people, using 6 different measures of racial animus. And more broadly in the data, the higher chance of Black-owned firms of getting a fintech loan is magnified in areas with more racial animus. And we're able to use the data that we get from the fintechs to rule out a bunch of other sort of obvious explanations you may be thinking about for our findings, including pre-existing bank relationships, application behavior, and fraud.
Super interesting. Okay, so let's do, oh, Connie,
I'm sorry.
go ahead, please.
I just have
No,
one
this
follow-up
is
question on
incredibly
that, because
interesting.
many of the CDFIs during PPP were able to do so much lending because they did partner with fintech companies. And so does your research reach into that? Because in addition to what you're saying, I would think that a piece of the research that would be important is understanding how those fintechs reached that Black audience. And I know that our CDFIs, who serve more of the Black and brown audience, were partnering with PPP. I mean, with fintechs during PPP.
Yes. So this is an important point, and it is not really addressed in our paper because we don't see, first of all, for the whole PPP, we don't see applications. We see applications for one analysis that we do to the Lendio platform. But in general, most of what we look at is conditional on actually borrowing. We don't see how borrowers are getting to the place where they apply. And I've heard sort of from, in a sort of an anecdotally, that certain types of lenders like CDFIs referred applicants to fintechs, right? And so they said, like, look, we can't handle this volume, but go over to Blue Vine, they can help you.
Yeah.
And so I would say that is an important, could play an important role. And we sort of argue, we're able to show with the Lendio application data that when Lendio referred, in the PPP, they just performed this very simple sort of referral process. They didn't do this more complicated matchmaking that they do for marketplace loans. And we showed that when they would pass Black-owned applications to conventional lenders, those applications were rejected at higher rates than other applications, while there was no such pattern for the fintechs. And so that tells us that something is going on here beyond just that idea that Black-owned firms were applying more to fintechs, which could explain some of what's happening in the bigger data and may reflect partnerships with CDFIs. Unfortunately, I'd love to work with data from CDFIs, but we don't.
So it looks like we have a new partnership originating here, which is exactly what we're about.
It's an important piece in terms of where fintechs are able to reach, right?
Absolutely.
I mean, it's talking about reach, which it's not addressed, but I think it's an important issue.
So let me do this. We're going to come back to partnerships in a second, but let's step back. And given the current economic environment, we are seeing rising interest rates. There's expectations for a potential recession. What does that mean for small businesses? So David, maybe I'll start with you. I mean, what are you all seeing, hearing from small businesses, and will it change their needs when it comes to credit?
Yeah, it's interesting. I think the rhetoric has changed recently. There's been this disconnect between, I would say, Main Street and Wall Street for quite some time now. In that Main Street is still performing really, really well, despite some of the headlines. I think that's changed in the last few months. What we're hearing from clients and what we're seeing in some of the surveys is there's just a general reduction in business confidence. Expectations for the future are deteriorating. And that's going to take its toll. As consumers start to pull back on spending, that's obviously going to impact the small business. I would say as it relates to, maybe I'll say the provision of credit more broadly, when I think of it through the lens of fintechs, we've certainly seen a number of fintech partners start to pull out of that lending space at a time when some of the needs are starting to increase. And I think they're pulling out for a number of reasons. Some of those reasons relate to just the fact that rates are increasing and their cost of capital is increasing. The fintechs are obviously not banks, so they don't have access to those deposits. They still are playing in the capital markets where you've got a widening credit spread, right? So I think that's a piece of the story. Another piece is, fintechs are largely in cash conservation mode as well. Yeah. So committing capital to lend and do it on balance sheet is not always the most efficient use of capital. So I think you're going to see some optimizations there. In terms of the product specifically, the areas where I think are going to develop more are really those revolving type lines of credit. I think longer 10-year term loans are going to be largely out. And certainly for fintechs, loans where you have a shorter duration, where you can regularly underwrite, understand what's happening with the customer base. Bluevine, we do daily underwriting.
On a line of credit type product, so you can assess the current health.
Yeah, so you have much more of that information. So you have a lot of leading information about what is happening with a specific client, but more broadly within a specific cohort, right? So whether that's restaurants, whether it's construction, like you get a really rich data set to understand what's happening across the board as a leading indicator. And obviously that'll impact future credit decisions that are made.
So Connie, let me ask you, I mean, from your perspective, same question, and then Sabrina, if you have additional to add on this, anything that you're observing right now about the state of small business?
Yeah, it's really interesting. We just came from a meeting with SBA where we just said exactly what you just said, that what we need, what our business owners need is a line of credit, that even though there's a lot of optimism, they are aware that something bad is getting ready to happen. Another change, another wave is coming, and they need to be prepared. And how they get prepared is through a line of credit. What we're hearing from our CDFIs is that a lot of the small business owners are not ready for capital, not ready for debt. And so many of the CDFIs are packaging like 80% of the capital in debt and 20% in grants. Grants played a huge issue for businesses during the shutdown, during the pandemic economy, but we're seeing that business owners still aren't ready yet to go full debt. And so many of the state programs and government programs are being used to provide grants. And so CDFIs got swamped with a lot of money from private sector as well as the government. And so they are flush with capital, but to get that capital in the hands of business owners, they're having to be more creative and do, again, combination loans, grants and loans, or things like that.
Interesting. Sabrina, any additional points on this?
So I think these two are the experts on this front. But one thing that's interested me is the remarkable increase in business entry since the middle of the pandemic. So there was a spike in exits in the middle of 2020, but it was more than compensated for over the following months by a higher entry rate. And a lot of that was that the closures were temporary. Businesses closed and they reopened. But then this discontinuous high increase in firm births has been sustained through last month, at least. So, and it's like a 40% increase relative to previous years. Firm births go like, and they went, and now they're staying up. And I'm really interested to see if that is sustained in a higher interest rate environment.
Well, and the products for companies that are that early stage is different than a 10-year-old small business, right?
Exactly. Yeah. Exactly. And so I think that's actually a good sign. You talked about what is the state of small business. I think it's perhaps not as dire as some folks may think. Yeah.
It's interesting. Like there is a lot of small business creation. I think the type of businesses which are being created may be different this time around as a result of the pandemic. And one thing I would add is, to some extent, the businesses have now playbooks. Like the ones that went through a pretty drastic U-turn, they have a playbook. It's been difficult for them to overhire. It's been difficult for them, I would say, generally. So they've been naturally more conservative. So, being optimistic, it could be a reasonable sign that things are going to not be as bad. But I think a lot of that is up to the Fed right now.
Can I ask how the businesses are different? You said the businesses are different that have been founded?
Yeah, I think during the pandemic, a lot of people left and they went and created their own firms, started work for themselves. They have lower overheads. Their cost base is potentially different. And as well as the ones that went through some major distress, they have a playbook now. Right? They've got used in this inflationary environment to raise prices. They have steps that they can take. They've negotiated with suppliers. They've done a lot more to, I would say, steady themselves.
I think the other thing that we're seeing, though, particularly, I think this new startup that you're talking about is still being led out front by Black women. And unfortunately, there has never been, Black women, Black people have been leading the startups for some time. There's no problem in starting. The problem is there's a really short runway. because they can't get access to capital most of the time. And so no problem starting, but the question will be how many of them will be able to get access to capital and the resources they need to really take off.
Especially when you don't have demonstrable cash flows from
Exactly.
years of activity. So, Connie, let me stay with you. I mean, you've been an absolute leader in trying to bring technology, fintech partnerships into the CD5 space. Can you talk to us about what you've seen over the years? What's worked well? How can tech partner with CDFIs to better serve?
And who better to ask that question but you do? We've been partners in since On Deck and like in the early startups of the starting period of On Deck. AEO was the first to partner with a fintech company to really bring the technology, the product innovation, as well as the process innovations to communities, to low wealth communities by partnering with CDFIs around the country in our network. We had a great collaboration where it allowed the CDFIs to offer a new product in their community, same value, same speed, same everything, except below market costs. And so while, I mean, we were on deck when it was 70% interest rates, and we were able to get that same product into low wealth communities at like 22, 23% interest rate. Plus, we were able to bring our own capital. So while you were chasing VC capital, high expensive capital, we were able to bring low-cost capital to the partnership, which allowed it to work. We brought the trusting relationships, we brought access to a low-wealth consumer base, and then you were able to bring your technology and the underwriting that, you know, was better suited for many folks in our community. So that was one of the first ways we collaborated. And then with the ILPA, AEO worked with ILPA to bring across the smart, I just forgot the name, smart card.
The smart box.
Smart box. And then again, working with that to really talk about the policy part. How do we, and I think we were, you would agree that we were effective in helping to push you guys to actually, you know, stick to some real lack of discrimination and being able to reflect on what you were doing to community. So it was a great partnership that resulted in something that many of those in our community include. I have one little quick anecdote. I was giving a presentation at the Federal Reserve Board, and two of the leaders at the Fed came to me and publicly apologized. We were the scourge of the earth for years because we were the first to partner with FinTech. And that's when FinTech was seen as, oh, terrible by everybody. But they apologized to us to say we were ahead of the game. We were ahead because of our open thinking and innovation that we did together. And so what we were basically doing is using the strengths, the assets of both partners to really get capital in places that were hard to reach. It was a great partnership. We want more. So yeah, it's a lot of opportunity.
Well, so for David and Sabrina, I mean, we're here in DC, so we should be talking a little bit about policy. From a policy perspective, what would you like to see done on a number of fronts? What can be done to foster partnerships? How do you level the playing field for small business finance? Are there consumer protections that we need to be thinking about incorporating? So, you know, I know we're short on time. We could delve for hours on each of these questions, but what are some ideas you have from a policy perspective? And David, maybe I'll start with you.
Yeah, I mean, maybe I'll start with three quick ones. I think at Bluevine, we welcome transparency and we welcome regulation. I think disclosures is a key area, which can be a good way to level the playing field across the board. So specific disclosures for SMBs, I think, is one. We were supporters of both the Californian and New York bills, which I believe went into effect. On top of that, I think APY, right? Has our API having clear focus and requirements around APY is critical. And then I would say more generally on the policy front, I mean, maybe just to pick up on Connie's point, I think, you know, there is this perception that fintechs are nefarious in some way, and I think trying to break that myth, like get to know what the different fintechs are about. I think the fintechs potentially have to do a better job of that as well, explaining what we do, what our methodologies, what our risk management structures like. There is a great variety in fintechs across the ecosystem. And there is a great disparity, I would imagine, between the risk and controls and governance that they have in place. And I think Bluevine, we consider ourselves one of the leaders in that area, really focused on the governance structure, full BSA programs that we have. So urging the regulators and the lawmakers to really get to know the individual fintechs.
And so, Sabrina, I mean, you have a magic wand here, and you can make policy happen overnight in Washington, because that's how it moves here. What are your suggestions?
Yeah, well, I think a theme that I've heard all day today is that there's sort of a need for a kind of a two-pronged approach. With one arm, fintechs should be brought, roughly under the same regulatory umbrella as everybody else, that there shouldn't really be room for regulatory arbitrage in lending because there are bad actors and there is predatory activity. But that with the other arm, the government, and perhaps I think that the Fed might be the most important actor here, should be giving non-banks potentially who are subjecting themselves to the same levels of compliance and scrutiny that the regulated banks, the insured banks are undergoing, that they should also get access to resources like payment rails, a future Fed Now, to Fed accounts, to future liquidity facilities. And to go, I think that speaks a little bit to what Connie was saying about the high cost of capital for fintech lenders going to VCs, going to hedge funds. Like a big chunk of the high interest rates that are being charged is is because of that very high cost of capital. So by accessing these, by accessing Fed resources, we can potentially reduce that cost of capital, and I think enable fintechs to access liquidity facilities that may arise in the future. So the PPP liquidity facility was tremendously important in driving, the large volume of fintech lending that happened. They didn't have the balance sheets to fund that themselves, and right now that requires all kinds of special exemptions to allow lenders without Fed accounts to access that. And in a coming recession, to this point about lines of credit, having the ability to provide forbearance could be really helpful. I think that was very important to the lower rates of default at some of the banks relative to fintechs in the pandemic. If you can give a 4-month forbearance, you can actually sometimes get through some of these crises.
So let me stay with a policy consideration. So the SBA is currently exploring expanding participation in the 7A program by lifting a moratorium on non-bank licenses. I believe it's been 40 or so years since the last non-bank license was granted. What might that do? And David, I can start with you. I mean, how do you view the 7A program, and is that a big move forward in terms of expanding access?
Yeah, I think it is. I mean, firstly, we welcome the SBA doing that. I think it shows, expanding the access shows a recognition that fintechs have a part to play, clearly from the distribution standpoint.
And I think Sabrina's research may have contributed to that.
For all the reasons that Sabrina stated. So, I think that's phenomenal. I think fintechs, we talked earlier on, right? We do make smaller ticket loans. We have a more efficient platform. We have the reach. We're not reliant on a branch network. So I think it's a really positive step in the direction for fintechs more broadly.
I think it's not only a good reach and a good condition. We were recently put in our comments for SSBCI as well as some of these other projects that are coming out of Treasury as well as SBA. And we think they're all opportunities for fintech to play a role and making the regulations different and changing those. And it's not all of them require major changes, terms and conditions, and some other things that fintechs need to come to agreement with the government and the legislature. But I think there's real opportunity to access. I mean, there's so much money that got passed through SSBCI, for example, and we're concerned that we actually have a working group because we're concerned that those resources won't actually get into the hands of Black business owners, Black and brown business owners. Fintech can help with that. They can play a role with that. We were also talking about the new rule that you just asked about with the moratorium lift. AEO personally is not interested in becoming a capital provider. We could do it with a partner. And so there are lots of opportunities, I think, in the legislation right now.
That's interesting. Sabrina, last thought on SBA 7A moratorium?
I think as long as the fintechs comply with the same eligibility rules that everybody else does, there's sort of no reason why they shouldn't be able to participate.
Sounds like a good point to end on. So join me in thanking our excellent panelists on small business, and we'll turn to the next.
Please welcome back Penny Lee, who will be joined by Ryan Sandler, co-founder and CEO of TrueWork, for our final fireside chat.
Ron, thank you all for staying around. I know it's been a very long day and appreciate. And for those that are on the live cast, very much appreciate everyone staying here. It's been a tremendous day with incredible conversations, and appreciate all that we've learned, heard, and made us think and think through exactly how we both need to be as a fintech company, but also thinking through the balance in regulation and kind of what we can do for consumer protection. And really excited to meet, to have today one of our founders, Ryan Sandler, who is the co-founder and CEO of TrueWorks, which might not sound like the sexiest kind of company, but it is one in which is critical, especially to the infrastructure. And he is reinventing what we would call the consumer bureaus, rating agencies, and thinking through how we need to change the landscape of it and how we need to move. And so, Ryan, I'm looking forward to this conversation. And let us just start with, because you can explain your company far better than I. You are at LinkedIn, and all of a sudden this idea pops into your brain. This is not something that usually is normal. So tell us, what was that thought bubble that you had that made you start TrueWork?
Yeah, thanks so much, Penny. So as Penny mentioned, I previously worked at LinkedIn, where I created a product called LinkedIn Salary. It was a competitor to Glassdoor, if you ever use that. So I care a lot about salary transparency and privacy and some of these tenets. And then I discovered this world of income verification, where within the credit bureaus, it's very much more commonly talked about their credit business, but they also sell income data. Specifically, one of them had a very dominant position in the marketplace, you might say. And the space was very under the radar, very unsexy, riddled with privacy issues. And this was what I was looking for to go and go solve. How can we bring control and ownership of this really important data, your income data, to the consumer, where right now it's this really black box, and we'll talk more about how it works.
Yeah. And so you thought, how can I access it, or what is it that I can do? Was it more from an access? Was it more from a cost structure? Was it more from making sure that I just need to fix what the credit rating agencies are doing, or consumer?
Yeah, it's as mentioned, it's one of the big three elements in getting a loan. They check your credit, your income, your assets, and for income in particular, it was just so broken. I mean, what the banks or the lenders really cared about, what was broken, was that there's such low coverage. I could only verify 30% of the population. For all of these other workers, including 1099 and these really growing demographics, it's really hard to verify their income. So that was the pain point we're solving directly that we found in the market. And then for me personally, it was privacy. The fact that a single company is storing all this data centralized for 30% of Americans with very, very poor security was really scary, honestly. That anyone can kind of go onto this website and answer a couple of questions and get your income information. Like, that was scary. And so, can we create a better solution that was more private? Was really why I started it.
And so you put together this thought, you put it down on paper. Curious what your first pitch deck looked like, and maybe what your pitch deck for your Series C, congratulations on your recent round. What was that first concept, and how many people said, not really my thing? And how did you get adoption therefore, and maybe how you pivoted now to what you showed in your Series C?
Yeah, absolutely. Yeah, I mean, I think early on, especially when it's just a few people and a deck, you're selling this big dream that we could take on this massive $30-40 billion company, and there were definitely
What was your TAM at that point?
The TAM of the market, we would say, was like $5 billion. Of of course, we had zero in revenue.
But a big hockey stick coming.
Yeah, a huge hockey stick of where we'd go. And, some of the core tenets, have definitely remained the same, but, investors really had to believe early on that this is going to be a business that takes time. Like, there's a lot of compliance, regulation. You have to go and partner with tons of payroll and employers we'll talk about. It just takes a lot of time. And so there's a lot of people like, there's no way you're going to be able to compete with this bureau. This is a multi-year process. And so really showing how compelling it is to lenders, especially as you get more and more data, is something that people had to believe in. Yeah.
And what was your first big win that kind of said, this is a viable company, a viable solution?
Yeah, I'd say like the moment where we realized we had quote unquote product market fit was about a year into starting the company. Soon after we launched, and we knew it would take time to get to large enterprise banks. A lot of security requirements, and so we put up a self-service product for smaller banks, smaller lenders, credit unions, where they didn't have to plug into an API. They can just go in and enter a credit card and get information back. And that thing started becoming really, really popular really quickly. I think we, went from like 0 to hundreds of customers in 2 months, and we realized, wow, this thing is really working. People are just coming and using this themselves. And then later on, we went to the big banks and big lenders.
And so in that first iteration, was it consumers that were using it to be able, like, how were you getting, they were asking for a car loan, they were asking for what were they asking for that they were using the service?
So it was loan processors at lenders.
Okay.
So it might be, loan processor Quicken Loans who says, I need to verify income for this mortgage. I need to find a vendor that can do it for me. So far I've only dealt with really one vendor, and they would discover us maybe through Google and start using the product.
And would you say you have a competitive set? Is there a competition other than obviously the established brands, but is there other fintechs or companies that are in this trying to do the same thing?
Absolutely. I think we're excited by the fact that since we launched the product in 2018, there's been more and more players in the space, which is great. There's more and more competition where pre-2018 there was really one player. So we're pretty cooperative with, I would say, a lot of other folks taking on different attacks on the space, you might say. Whether that's through getting the data through scraping, getting the data through partnerships. We are cooperatively working with different players as we kind of go against the legacy.
And I was going to say, how have the incumbents or the legacy kind of reacted to you?
Yeah, it's I'm careful on how much I speak about them, one company in particular, but generally they don't make it easy. You can imagine these are massive businesses, and we're still 100-person team, and I think we're excited about discussions in Washington where they make it especially hard is with exclusive access to data, right? And so we talk a lot about open finance today. We kind of think about this world as open payroll, you might say, where consumers should be able to share their income data with whatever lender they choose, and it should be really easy and instant to share that data. But if one vendor intermediary has exclusive access to a lot of that payroll data, they can charge whatever they want for the data. It's a very, very anti-competitive lens, and you can imagine they are doing everything they can to retain those exclusive relationships.
And who gave them the exclusive rights?
It's the payroll platforms themselves.
Okay.
So where you get paid on your paycheck, that company is a payroll platform. There are 10, 20 major ones. We work with some major ones like Gusto and Rippling and ADP, but you can imagine there's many, many more on that list. And some of those may have created an exclusive relationship with a bureau where it allows only that bureau to get access to that data.
And are those long-term usually contracts, or those how long do those go in? What's the opportunity to break those contracts up? Like what would cause them to be non-exclusive or enter into a different agreement?
Yeah, well, we think, of course, it's better for the consumer for it not to be exclusive. More competition leads to cheaper price to get access to that data. And we show those payroll partners that they could actually make more money if they work with more providers. They will have a better user experience for the employees on that platform, that whenever they go to a lender, it's easy to verify because it's not just one player that they can access. So they definitely expired. You can imagine we are on top of many of them and pitching our case, why they should be non-exclusive and work with any consumer reporting agency, not just one of them.
And is there things legislatively that can be done, regulatory that can be done to kind of break up a little bit of this monopoly, or it's private company engaging in exclusive contracts?
Absolutely. I mean, I think regulatory wise, we are of course responsible to the CFPB and to the FTC as a CRA. So starting from day one, we defined ourselves as a consumer reporting agency. Of course, it means that we have to handle the data in a certain way. It has to be accurate. And we think any company handling this type of data should be a CRA. And it's been important for many of our banking and payroll partners that we are a CRA.
What was required for you to be a CRA?
A lot of it's in the product, right?
Okay.
And these are product requirements that we think are innate, should be in any product giving this data, right? Consumers should be able to have access, see what data is being delivered. If the data is wrong, there should be a way to dispute that data. And so we think you should have that accountability as someone handling this really sensitive data.
And how much do you think, we do see complaints at the CFPB on the bureaus, a long list of either people getting their credit scores wrong or not having, certain things were taken into consideration, not taken into consideration. Does the same apply on the employment data? Is data coming in wrong?
It can. I think what's really essential to the way Truework works as a digital platform is you're actually able to show the consumer in real time what data is going. You can imagine if you're like a sales employee, especially, you have a base salary and then you have your bonus, and that bonus may not be represented well when you go and apply for a loan. And so actually showing the consumer, like, is this right? This is what's going to be shared with Bank of America, has been really important to catch any inaccuracies. You can imagine if it's a complete black box and you go to a loan, you apply for a loan, you don't even know this data is being shared. You don't know if it's accurate either. So absolutely, there can be inaccuracies. It can also be hard to track sometimes if it is a black box. But we think that consumers should have access to that data as much as possible.
And do you see is that something that, I know we're talking 1033 open banking, but is the next evolution when we talk about open finance, is that where you see kind of this role, the role that you're playing kind of fit into to be able to allow this greater access to portability of data?
Absolutely. So we're really excited about 1033. It doesn't currently cover payroll, but we would, we'd love to see, similar guidance for payroll data, right? I mean, namely that data should be open and require consumer consent. Anyone who is a regulated or accountable intermediary should get access to that data, not just a single entity. And that's what we consider very much a part of this concept of open finance. Not in a way where someone can easily just switch their payroll. It's just that in a read-only way, any lender can check how much money you make. Really simple.
And how do you work with, or do you work with 1099 gig workers, those that don't necessarily, that are more contract workers?
It's a huge, huge part of what we do in terms of extending coverage of payroll data. So we have, a big partnership with DoorDash, working on partnership with other folks like them, where if you're a DoorDash driver, your data can instantly be shared with that lender, which was really hard to do before. A lot of lenders would decline 1099 applicants because they cannot see a consistent income coming in. And as much as DoorDash together with Truework can show that, no, like this income has velocity, it's steady, it can be really impactful for those folks getting loans.
And did you and how does that actually work? So DoorDash is the employer, or how does that work? Especially with something that can have multiple sources of income too.
Absolutely.
If you have a DoorDash plus a Lyft driver plus an Uber, if they do all three, are you able to capture someone doing all three?
We are. The lender will come to us and say, I want to check their DoorDash history, their Lyft history, their Uber history. With DoorDash, it's instant because we have a partnership with them. So the lender will get the information back as soon as consent is given. With the others, there might be some amount of friction. The user might have to log into their Uber account, then their Lyft account. But all in all, the lender gets back all three positions and can verify their income.
And if you're wanting to go buy a new car, how fast can you capture that for someone sitting there waiting for it to be verified within minutes? Is it days? Is it take a little while?
Yeah, so 25% of requests are fully instant now, something we're really proud of. 45 million records we have access to with the user's consent. So, as soon as they say, I want to share my income on a Quicken Loan application or when they're buying a car in person, they get that information back. And we're trying to make that 100%, as fast as possible. When it's not instant, we bring it back within minutes, within an hour. We'll tell the lender how long it'll take. And, again, this is really impactful for this data to be as easy as a soft credit check. It's instant. You can get the information right on the spot so you can approve for a loan.
And is there a difference in how you're processing your data, whether or not somebody's doing a soft pull versus a hard credit pull?
With income, we have not, created a difference between them. And part of it is we don't think there should be, any kind of ding to your report. There should be no concept of a hard pull. And so no, there's no difference for us.
And where do you see your future? Is it just greater adoption? Is it displacing some legacy? Where do you see True Work kind of heading? And is it always going to stay in employment-only data?
Yeah, so right now we're really focused on this world of income and employment data. We've have a lot of mortgage lenders on the platform, and we're getting more and more traction now in consumer lending. It's something where we're investing a lot. This data is really important for mortgage. There's a lot of guidance from Fannie and Freddie, but on the consumer side, it's a bit more discretionary. For an auto loan or credit card, do you use credit? Do you use income? It's up to the lender. And we're seeing, especially during recessionary times like this, lenders want to bring in more alternative data, right? You're flooded with applications. How do I look at someone's income as well as their credit? And so getting our API layered in and as much of these different types of lending applications is where we're focused on now. And in the future, we think a lot about other types of financial identity like income that has been really hard to access. I think there's a lot of interesting talk about rental history data. Right now, some companies doing interesting things there. Those are the types of alternative data that we're interested in as well.
And did you all engage at all with PPP, with any of the lenders involved with the PPP loan process? And were they able to, I know it took a little while for especially fintech companies to be able to kind of be allowed to kind of lend during the PPP program. Were you part of that as far as an income verification part?
Not directly. We definitely thought about how we could help, but it was much more focus on B2B lending, where we focus on B2C lending. So not as applicable. I know Plaid did some really cool stuff there. We've definitely been more recently with student loan forgiveness is something that we've had a lot of really interesting conversations. The problem of verifying your income to get student loan forgiveness is pretty messy right now. So we'll see if there's anything we can help there.
And love to get some insights on that. I mean, how is that process going?
It's, you can imagine, there's different amounts of urgency per different parts of the process. And for income verification, I'm not sure it's the highest urgency. So it is pretty messy. I mean, someone just has to go and upload pay stubs and prove that they make less than 120K. Areas of possible fraud, and also it just takes a long time. Many people don't know how to get their pay stubs. So, we'll still see if there's opportunity, but so far it's been a bit slow.
And you do bring up fraud, obviously is something that's of interest very much to our regulators. Talk to me through how you are preventing fraud and not having someone mimic somebody, or what is the biggest issue you faced from a fraud perspective?
Yeah, I mean, I think often what bureaus face in terms of fraud, I mean, of course, there's fraud on the consumer side, but there's a lot of fraud also on what we call verifiers. If someone says they're a lender and asks for information, we have a very, very strict process on how we approve lenders or how we approve companies to come and actually access information on the platform. And so that's where, unfortunately, I think some of our competitors have faced some challenges. If someone really wants to get access to your income or sensitive information, they can on certain systems. And with us, it's really, really difficult. We go through a number of checks and hoops to make sure that someone seeking illicit information can't actually get it.
And do you, when you say you vet your lenders, do you vet them from safety and soundness, from an APR standpoint, meaning you don't work with anybody over a 36% lending vehicle at an APR? how do you verify, or how do you vet your lenders?
Well, for sure, first and foremost, is are they a real lender or a financial institution that has permissible purpose, per being a CRA, to actually access that information, right? And then secondly, where we really focus is the consent. Where is the consent in their process to actually get us information? If it's not there, we're not going to work with you.
So we've seen, we're in Washington and we keep bringing this question up, and so we'd love to get your lens as well. Shift in Congress, likely. Looks like Republicans will be leading the House Financial Services Committee. Democrats will still stay in control of the Senate. Obviously, President Biden is still will be the president. Do you have a sense of kind of what might change from a regulatory standpoint with this new Congress?
Yeah, I think for us, this is a really bipartisan issue, like 1033. When it comes to the bureaus, I think there's a lot of momentum on both sides to increase competition, right? I think there's many people who are not a fan, you might say, of a public credit bureau. And I think we really strongly think that the right answer is more private competition. And so when we recently wrote a letter to the FHFA on what are some of the priorities in terms of guidance that we think there should be around this data. And first and foremost, we mentioned this concept of 1033-like reform for payroll data. How it should be open and accessible with consumer consent. Number two, the intermediaries actually providing that data should be regulated and accountable. Number three, that data should be instant. Number four, it should be accessible via API. And so we're really pushing for, we think there's just so much opportunity for consumers, so much increased coverage of consumers, including folks like 1099, that can be served with this, with some updated guidance on how we can make this data more open.
And are you state regulated and federally regulated? Are you having to adhere to 50 different state laws?
Fortunately, federal.
Federal.
Not really state, which is a great thing about this country.
You're the one with the federal preemption, which is great. I want to step back just a second and go back to your founder story. If you'd known what you were going through and where the company is, would you still have started this type of company?
Absolutely.
And what were some of the lessons, I guess, along the way? Have you made some changes to your baseline business?
Yeah, it's a great question. We have a multi-sided marketplace here. On one side, we have the lenders. The other side, we have payroll platforms and employers. And for quite a long time, a couple of years, we didn't really care about the lenders at all, frankly. We were just focused on growing the data source, working with payroll platforms, working with employers, and then kind of had this shift where we realized we need to go and bring on the big banks, bring on big lenders. And I think I wish I did that a bit earlier. But no, I think generally I'm happy that we took the CRA stance early. I'm happy that we invested in Fannie Mae Day One Certainty early, which we just got last year. It takes a long time. And hopefully we'll soon have Freddie Mac approval as well. But I think we realized pretty quickly, like, you cannot sell this type of data to banks unless you're approved by Fannie and Freddie. They just will not use it. And so that realization came a couple of years in. Maybe wish you had that a bit earlier.
And you went mortgage first versus student loan versus others. Why'd you go with mortgage first?
Yeah, mortgage, it's a great question. Mortgage is the biggest market. I mean, first off, like, the biggest size loans, the more important income in this data becomes. And then also, it's pretty much required per Fannie and Freddie. They have very strict guidelines for mortgage. If you want your loan to be bought by Fannie down the line, which most big banks do, you have to verify income in a very specific way. And so with mortgage, if it is pretty much legally required, there's a really big urgency, you can imagine, to get data and get it cheaply and accessibly for income.
And how much of your business is working? You said you went into the big banks. You're now hitting that market penetration. But what percentage, or do you work with novel banks, others, a SoFi or others that might be newly chartered or still waiting for their charter?
Absolutely. And you can imagine, kind of our go-to-market, our ordering of things. It was non-bank lenders first for us, and then the banks later, because of requirements like Fannie and Freddie. The non-bank lenders had a bit more flexibility. Folks, Quicken Loans, you can imagine, Rocket has a ton of flexibility, and folks like SoFi as well. So those were definitely more of the earlier customers, and now only are the larger, more legacy banks.
And what is your market penetration in those more legacy banks, or is the one that has the black box? Are they just so dominant? What's the shift in market cap or market share?
Yeah, I'd say we have like 20% of what you consider major banks. So still a long way to go. They are, for good reason, sometimes the slowest to adopt new technology. We're excited that this year in 2023 will really be the 2 years that we're bringing a lot of big banks. When we think about non-bank lenders, we have the most of them at this point.
And what we did see during the pandemic was a spike or a spikiness in cars. People buying more used cars, not used cars. You just saw an incredible amount of spike of people buying cars. Did you all see that come through in your own data of being requested? And would be curious to know what your data is tracking right now as far as what consumers are spending or wanting loans for.
100%. So we are, we do have some horizontal view here from working with so many lenders, which has been really interesting over the past couple of years, especially. I mean, of course, during COVID, you saw prices of auto. And also mortgage, volume was pretty insane, where we were brought in with pretty high urgency for both mortgage and auto. Now you see, of course, mortgage being depressed with high interest rates. We'll see, somewhere on average of 20% decline in volume for mortgage customers for new originations. But with a lot of other consumer lending, especially personal loans and credit cards, I mean, we're seeing higher levels now than since 2008, which is not that great of a sign, obviously, right? Where people have very low savings right now, and personal lenders and credit card lenders are being overflooded with applications right now. So for us, because we serve all of them, it helps our business because we're able to service some versus others during booms versus busts, and you see that in the bureau's business as well. But it's been really interesting how that shift has happened really greatly.
And what did you see during COVID? When you did have the lockdown, when you did have a flood of government money coming to individuals as well, and boards online, maybe shopping online for cars and mortgages, or a lot of shift. What did your data tell you about kind of where consumers were headed or where they were spending during COVID?
Yeah, well, the digital transformation was just so obvious, right? For the first time, you're seeing people buy cars online, buying houses online, and I think we were surprised. Everyone was surprised. Where these lenders were being flooded with tons of volume, but didn't have anyone in the office, right? It has quickly shifted to the remote world. APIs like ourselves and many others here saw a boom, during that period, right? It's hard to verify income the old way you're doing when it was done by 100 people in a room. They need to start using third-party vendors and help them scale remotely. So a lot of really interesting, transitions that really happened during COVID. I think people really started to see the urgency of automating these processes, just not having human dependencies in your organization. Someone to have to fax another person at the HR department it becomes really impossible when HR department's working from home during COVID.
And did you see that network effect kind of take place in a way that hadn't been done before COVID? Just your adoption rate went up. People were talking like this was just an easy API integration, much more so.
We definitely did see a lot of growth in COVID. Both the mortgage market exploding as well as this digital transformation happening, and I think it's where the volume was shifting. Right, we would go from seeing some volume shifting from legacy kind of more in-person experiences to the Carvanas of the world. Right. These fintechs coming to us and saying, our volumes are exploding 10x month over month. We just need help here, and that was really interesting. Is where people were going to buy their cars much more online during COVID, and some of that's come back for sure.
I was going to say, where is that? Is it still spiky or is it flatlining? Where is it now?
Yeah, I think you've seen much more reversion to the mean, for certain in-person purchases, but there has definitely been an increase overall. But yeah, I think auto loans, for example, once COVID started ending, people were going back to in-person buying.
Where do you think is the next sector? So you have mortgage, you got cars. Where is your next sector that you're going to be going into?
Yeah, another thing I didn't mention, of course, with mortgages going down is rentals is a really, really large volume right now. Another area where, a ton of folks are trying to come in and plug in. You need better credit history, you need better income history. They want rental history, as mentioned before. Rentals, background checks, life insurance. There's just a lot of verticals that can use our API, and it's just prioritizing.
And we'll leave on one note, since you are a founder CEO, would love just thoughts, especially for the virtual audience, a piece of advice as a founder, as starting a company disrupting a very entrenched industry. Any advice you would have?
I'd say we spend a ton of time upfront really validating the idea and finding this product market fit. And the idea is one thing, the passion, but really spending time with customers early to validate the idea, validate your approach will save you a ton of time down the line.
That's great. Well, Ryan, thank you so much for coming, and thank you. And with that, we are closed. This is the end of the FinTech Summit. So thank you all.
Thanks so much.
Let me just say a quick word. Really want to thank everybody for attending. Want to thank our sponsors. We have Klarna, Marqeta, Intuit, Stripe, Plaid, Morgan Lewis, Zest AI. Thank you, everyone. And we look forward to seeing you again. So thank you. And protocol. Bennett? Sorry.